All right, so is my audio good? Audio good? Audio? Somebody say something somewhere. Okay, so for anyone who's just showing up to watch this video, we're going to look over what's going on in the markets. We're going to get an idea what's happening. There's a narrative that's been built up, and I think it's giving us an idea of probably what's gonna happen. And thank you, Burger Analytics. We're gonna get an idea of what's coming up based on this narrative. This narrative is going to be higher complexity, and the reason for that is that you need to have sort of a longer memory, multi-day, to get an idea of why events today are important and what's likely going to happen. All right, let's quickly go over where we're at. Looking at yesterday. Well, actually, you know what? Let's start. Okay, yesterday, Friday. We don't need this one. I moved my face so you guys can see this. All right, so here's the rudimentary the 30,000 foot overview. Bears cheated here to drive it down. They thought that was great. They tried again. It didn't work because cheating or insider trading is a short-term thing. So you don't get long-term trades out of the, it's like, something ahead of the game, you bet big and you take a short-term gain. You don't assume that insider information is a great swing trade. That's silly because at some point the inside information comes out and you're no longer in, your advantage is sort of over. So they overstated themselves, got stuck. We watched them on Friday all afternoon, tried desperately, and what the bulls did, let's take a look at the bulls. They did something great. They showed up right into those lows here and here. Boom. And they just waited. They're like, oh my gosh, we just waited. So they waited. We get the bears in this position. And what's happening is they're being primed with pride. You cheat a little, you think that and here's the mistake. Are you ready? You think the things you do create the outcomes you see. And that's just wrong in markets. So you can't just do a thing and get profits. You need to say, I have a reason. Now, yes, I'm like thinking on Friday. Thursday, they did a thing, cheated, got an outcome. And that's really dangerous because it gets you thinking wrong. So Friday comes, bears get trapped. This is important information. Bears are stupidly handling this, poorly, just awfully. They went for a second leg and they shouldn't have. Let me talk about this for just a second. You need to know this philosophy. If you see a buy and you buy into it, it moves up, gives you some counter signal, which is going to cause a pullback, right? At this point, just after the counter signal, right here, this is a new trade. Okay, holding a trade through a counter signal, unless you're anticipating that counter signal and knew it was coming, is choosing to enter a new trade. Whether the definition of a trade is not get into a winning trade, hold it until it makes you money. The definition of a winning trade is one that did what you expected it to do, not one that goes somewhere. So in this situation, you get your first leg, you get a counter signal. If you're not anticipating that and you hold, you're executing a new trade, whether you like it or not. Because like the bears found out yesterday, they tried to hold for the second leg, thinking that that was some inherent feature of markets. It's not. And the second trade failed. So what we're going to do, sorry, my camera's, so the second trade failed. So what's happening? How's this working? Okay. The bears are now stuck in a position. The market gaps up this morning. Get that in your, embody that with yourself. Just imagine to yourself what that would feel like. You cheated, you made a ton of money, you tried to hold for a second leg, now you're underwater. Got it? Okay, market opens today. It's the first thing you want to do. This is an emotional pickle, and it's a good pickle because it creates the kind of dynamics that get markets moving. And people are a little bit more predictable when we can see what they're stuck on. And we can see the bears are sort of stuck on this. So let's take a look at what happened. The market opened and look at what decay did. Whoa, just starts racing up. Where is it racing? Now, anyone if you guys worked the system, you can probably see where it went, but You get a decay retest. Decay retest has essentially 3 parts, but we're just going to look at the one. The first part is it tests. It tests I call it a major pivot. And a major pivot in this case, because it's multi-day, is the high or the low of yesterday. And this was racing towards the high of yesterday. The second part is trapped orders. I'm going to try TO. And the third part is what I call the lurch or new lows, where you see the stock market generate some new lows, like lurches. And then you're like, okay, it's moving. Okay, so getting those, we're just going to look at the test. Where is it going? My goodness, it is racing so fast towards this. The bears are desperate. So to get a decay retest, you need 1, a person who has no other options, and 2, somebody who is trying to get into the market. I think that the bears really, this is good. Why those 2 things? There's reason. 1, this is a decay retest. It's sort of a flimsy position, but it gives you the opportunity to get a foot in the market with a little bit of profits to try and get those profits working for you to get something going. So it's a last-ditch effort. It's something you do when you're like, I don't have any other choices. And look at the market right now. Do bears have other velocity's up, so the next sample's bullish. Decay is up, so the next sample would be bullish. Tension's up. They don't have any other choices. This is a perfect Hail Mary pass. And are they trying to get in? Yes, they're trying to cash average a loser. It's the worst decision you can make, but they want to. Because how do I know you want to cash average a loser? How do I know that? How do I know? Well, let me just tell you. You had something, let's call this, we'll put an X on it. This is something, and it was equal, and we'll say at time 1, it was worth money. And now, at time 2, it's worth no money. In this instance, I know you want to cash average because people can't say it was something that was just worth something is now worth nothing. Humans just don't deal with this well. And I don't assume anybody up at the tippity top of the food pyramid in markets is any smarter than anyone else. They're struggling with this. So what they're saying is it was just worth a bunch of money, so where's my money? It's like, you didn't close. You tried to hold for a second leg, dum-dum. So they're trying to cash average. So I know they want in. That's what's important. So we established they don't have another option. We established they want in. Great. You guys are screwed. That's perfect. So here's our decay retest. And look at what the market did. And don't look at this as though there's some, think about this. Bears want in. So let's make that premise 1. Bears want in. Okay? Look what the market does. Look at that. We get right up close to where the bears could get in. And it samples. Let me do the crosshair so you can see. Right there. Okay? Let's take a look right here. Look at what the market did just before the bears could get in. Now let's look at the trapped orders, which is right here. Okay. Boom. And we got a couple of, you see the red bars there. So we got all the pieces. What happened to these overly enthusiastic bears trying to cash average out of a loser? They got stuck in the lows. Stupid. It's the worst decision they made in a week. This is terrible trading by the bears. Okay, so we see that the bears have tried to cash average. So let's assume that they had a position here and they got here. So their cash average, I don't know, maybe somewhere here. It's probably in a couple players, a few major players here that got seduced by this cash average a loser idea. Okay, so the next question is, where do you put your stops? So one of the issues with a risk reduction is that it exposes your stop. I can pinpoint a signal and therefore a stop loss, which if you're a bigger player with a stop loss, your stop loss is a target. So your little trade better work. So looking at this, we can ask, where would your stop loss be? So, well, I've already marked it out because it's doing this. We could see that if you had shorted here, this might be a good spot. We saw a spike, and I know that's looking back 2020, so that would be a spot. Otherwise, the high, it's going to be here. That's where I think the stops would be for this risk reduction. I mean, really, you don't have a lot of options. You got to position into the lows. You're trapped in cash averaging, so you're going to make bad choices, and it increases your risk. And so I think that this is going to be the spot right there where those stops are going to be sitting. Okay, so now we've looked at what the bearish side is doing, where their stops are, how this is put together, why they're there. Now we need to look at the bulls. So we can look at yesterday. You can see they're right here into these lows. And these bulls just sat and waited for the bears to just take themselves out. And it worked. They just sat still. So we have bears in a very good position. And this market has something I call teeth. What are teeth? Well, it's sort of the way it looks in price, and sort of the way it feels. It'll like bite you real quick in that it'll tag your stop and then go the other way. So what happens is if the bulls tried to buy in today, let's say it moved down and they bought here, well, they have another position here. So they're going to be cash averaging in a positive position. So price came down to here, it didn't really threaten their average position. So this section here is the teeth. It's the fact that the bulls, or it's the idea that the bulls have a position already and they're adding to it. And so it can get a little messier around the stops. And so if you're trying to chase this idea and you're late to the game, what you should do is heavily consider that the market will have teeth, and look, if you're going to try, you try to participate with the expectation that teeth will exist. And that way you can ward off a lot of confusion about, well, I had this stuff and the stops. And so it's because cash averaging allows a lot of freedom when it comes to stop distances. And so, because they're not going to stop out down there. So it's like, fine. There's not a huge fear for them. And their position will be somewhere down here. So now we know where they are. Now I want to take a look at both of these sides that we've kind of put together. The bull side is a little simpler. But now we got to put these two together, and I think we're going to start to see just how the market's built right now. The first philosophy I think is important to consider is if you have the other side trapped in, especially this, which took 3 days to put together, these bears put into like a emotional knot, and they're making bad choices. The worst thing the bulls could do is to let the bears out. Don't. I mean, it's not like you just sit down and trap in more bears. It's not that simple. It took a lot of time to get the bears into it. It's not that they did it intentionally, but it happened. You know, they cheated. They tried to take a second leg. They got folded upside down. Then they decided to cash average their position and grab a risk reduction at the worst price. So you say to yourself, okay, well, I don't want to let them out, because then they need to find new people to trap. So let's take a look at where the bears are sitting. And currently, because of the risk reduction, right about here. So here's about where the bears' position for today is. Not that that's their cash average. And this is where their stops are. So that's important to keep in mind. It's just not a good idea to let out the loser, the guy who's going to pay, the people who are trapped into this nice emotional knot that you can unwind in a way that's favorable for you. So keeping that in mind, let's take a look at where the bulls could get liquidity. All right, so if velocity moves down at its current, apparent trajectory, it looks like it'd be about the close before bulls could get liquidity from velocity testing zero and trapping in traders. Decay, it would have to change character and just come right on down. This could happen too. Notice that both of those are quite a distance away. These are going to happen in the next 20 minutes or so. So this is a really big deal. What would price do in order to have this happen? Let's look at velocity. So if this is going to go like this, or shoot like that, what will price do? Well, if we're going to move this down real quick, right, it's going to show up in price. And we could see, if we did this one, this kind of thing happening, where price sort of it's going to have to move as you try and furl that velocity. You're accelerating the energy inside the market, and prices react to that kind of thing. So look at the risk. If we did this, it would cause this kind of thing. And gosh dang it, that would let those bears out. And I think that's the worst decision the bulls could make. Don't let the bears out. This was hard to build. You don't get these opportunities very often. So letting the bears out would be a bad choice, in my opinion. The second option would be to just let it move along this apparent trajectory. And what's that going to look like? Well, price would probably not much of an impact. So, and I don't mean the price will look like that. I mean that for it to go like that, its impact on price would not be all that much. So just doing nothing would be a great way to get bulls a sample sometime later in the day. So using a little rationality, which is putting these together, I would say, which one makes more sense? To pump the market down and get a bullish sample right just now, or to sit back and do nothing. And sit back makes so much more sense because you don't want to let those bears out. You don't want to let these guys out. Don't do it. This is great. Okay, so if the bulls do nothing, which I think is likely what's going to happen, they're going to do very little. I'd be surprised if the bears dropped the market if we got that to come down. It would take some sort of something. But if we don't have some jarring news event that's shocking and impactful, I don't think that's going to happen. So at this point, we built a case that says it makes more sense for the bulls to sit back and sort of let this drift. If we could get a squeeze going, an inversion would be perfect. This market is not about bulls. It is about killing off the bears. And if you've noticed, that's a pretty common theme when it comes to bullish trends. It's not usually about people buying. It's about figuring out what the other side is and emotionally setting them up so that they will take the greatest amount of profits. It's optimization of losses on the counterparty. That's usually how a trend works. So that's where we're at right now. We know where their stops are. We know what pickle they're in. Okay, so let's consider really quick a case for, before we get there, let's take a look at if we're getting a squeeze setting up. And the philosophy behind a squeeze is pretty darn simple. It's the idea that if you buy into a stock, you buy into a stock, and if you're the only one who buys and you buy a whole bunch, the distance that price moves in your favor, if you're the only one trading that stock, meaning it's just you, the distance that price moves is equal to the amount of equity you dumped into your trade. So if you put $100 in, you bought one share at $0, you would get the stock price at $100. It would move up to the balance that you injected. So if bulls buy into the market and they're holding and they have that cash in there, and the bears are selling and they're getting eaten up, what happens is prices are rising because there's bullishness happening, and that's bringing equity in a bullish way, and it causes price to rise without the internals. We don't need the internals. That would be so let's take a look at the tick. And that's this chart here. So this is the tick, and I'm just using this as a general measurement because it's measured by up tick, down tick in all the stocks in the New York Stock Exchange. And I'm comparing it to the ES to see that. So right off the open, we had a real high tick, and you can see it's been moving down. So what we want is to get the highest tick in the day, just a real good surge, and then no more new highs. Okay? And then I want to see that happen, if I could, while we push through these stops. And I think that what would happen is that would position us best to carry that bullishness up in the market. The bears are trapped. They got their stop loss in a bad position because they used a decay retest to cash average a losing position. It was stupid. We can run their stops, and if we can invert the market, that's important because if we just hit the stops, let's talk about this for a second because this is important to understand. If we just hit these stops here, it'll look like this. You'll see a pop. It's a quick little pop, and it's because there's money in those stops, and you see that pop, and it tells you, oh, we just liquidated or we stopped out. I wouldn't call this liquidation because it's too surface, like it's not complicated enough. This position. There's a few things that can happen there, and it's really important that you understand this. If the market decides to do absolutely nothing with this position, we're not going to invert it, we're not going to inject capital, we don't get bullish, then what's going to happen is that typically the distance of the stop loss, it becomes a spread. And if you're familiar with markets that stop out one side, they tend to move back to where the initial player who got stopped out, and it ends up being, no matter how you look at it, those sellers traded to themselves. They sold the lows and sold that sell to their longs at the highs, and it's a spread. It's just between you and your stop loss. is we haven't seen any bulls yet today. We don't have any bullish liquidity today that I see. This is probably going to result in a spread. But if we can invert the market, so this is the thing, is if we can get the market inverted, we can see more sell orders come in while price rises. Then those sellers can continue to pump and take advantage of this idea that the bears are cash averaging a loser, like the worst decision. And then we could get this to carry a little higher. So hopefully you can see that the context that we have here is a really big deal. You need to know what's been going on. And that's what puts this at a higher level of complexity. You had to understand yesterday, Friday, and Thursday. Put those together to say, oh my gosh, I see what's going on. I see why these bears are such dum-dums and why the market's going to chew them up. And the bulls are just sitting back. So then we look at this, we got a scope, we know where stops are, we know where positions are, we know what the mentalities are. Let's talk about the thing that actually matters in all this. I mean, we piece it all together. We got, I think, a really good scaffolding, and we know what's happening. So this is bullish. This is bullish. So we have this potential to do some sideways. I don't think there's any potential for this. I think that's just irrational. It would be the worst decision ever. And I think as quickly as they could, the bulls would pick this up because we don't want to let the bears out. I just don't think that. I think this makes more sense. And because of the conditions, I think that we're going to see drifting up. And hopefully at this point, we can get an inverted market that'll carry us up higher. And then, most of the way through that, then you hear people start saying, it's a channel, it's a channel. A channel is the result of this situation if that happens. And then you'd see a pop up as some sort of blow off would be the expectation. And then the trade would be done. You'd say, well, we were able to trap them in. But that blow off, remember, is not just from today. That the traders getting unwound forcefully are built into the market over 2 full days plus today. So it should be pretty exciting, if you know what I mean. So there's a lot of upside potential. Okay, this narrative is saying upside potential looks really good. We got people in, we got stuff looking terrible for them. They're making bad choices. Now, if we look at the other side, because this is a big deal, can't just look at one side, we got to get the other. Here's the other side. Let's take a look. If bears decide to, what I like to call bigger fish the market, where that you let these guys come in, right? You let them come in, they get the decay retest. When they stop out, we're going to be looking at open interest theft, OIT. That's what I got. Is that you let these guys write the contracts, create the contracts, build the contracts, and then you step in at a price that you like and take them. And that's important because if you're a big institution and you want to fill in the market, if you spike open interest too quick, things move around, people notice. So you want to steal contracts from people who spent the time and the effort and the risk building them. They're like your labor force. You come in as a person who owns the right to their product and you take their theft. It feels like open interest theft. I use the word theft because it's a little bit more of an aggressive term, because you have to remember that open interest theft is a thing. It's not a passive idea. They'll come in, they just see the orders on the books. They don't really care where it came from. We're tracking where it came from. And they see them, they say, we like those, they take them, they consume them, and then we get to track how the bears would respond to those. Now, right now, what you need to ask yourself is, will the bears consume or not consume that liquidity? Because open interest theft is liquidity. It's orders created by the market that can be handed to somebody to consume. Will the bears consume that liquidity? And looking at the context where everything's at right now, I think the bears would have a tough time justifying a downtrend. But if you're really crafty, you might say, well, there's no bulls today. So it might be that if we pick up this liquidity and we wait for the bulls to get sampled, we could take this profit right here. Basically, you consume the liquidity and you wait for the bulls to get in, and it's a little riskier of a trade because you don't have a lot of structure with you, but you could say, then I could take that profit and flip long and go with the bulls, who are probably not going to trap out, let the bears have any money. So what would that look like? Well, if they stopped out and you consume that, well, you don't want to move it down past here, because if price comes down past here, remember, you're going to start running into territory where you're letting them cash average out, and that's just not what you want. So I think letting this move down, oh man, there's a little expansion bar. This could be good. I mean, we pick it up, we move it down, we go like that. This could happen around 1:30 Eastern time. And at that 1:30 Eastern time could be about here. These don't line up with this. Sorry, I'm just sort of modeling this out, saying what would the bears be thinking if you were to do this? And the issue that I take with this is not that it couldn't happen. It's that if you're a large enough institution that you're real deep in liquidity and you're bigger fishing big fish, where these big players who are big enough to impact, change things, and you're coming in 10 points, you're going to consume all that liquidity with that much capital for 10 points. But we gapped up way more. I mean, it seems like it's an intraday trade. It would be very small scale. And if you're looking at those guys as bigger fish, I mean, it's just not like a doozy. And you know that you have limited downside because bulls are not going to want that to happen. So I assume, okay, are you ready? This is where I start to make conjecture. That if bears came in here, we'll call these, well, these would be like bears too. If the bears came in here, that the bulls would say, hey, and that the bulls might want this to go a little faster and sample them so that they could get this to turn them over before the market's closed. Because it's like, hey, you're stepping in on our game here. We don't really want people like you here. And so they might want to do that. Or it might be that these players are quite intimidating, and we see insurance products like options and stuff flare up as the bulls are like, yeah, that makes me nervous, and they start trying to. I assume they would be looking at that as a short-term move, so you probably see people selling calls, trying to, or yeah, I would sell calls for the next little while, and however far down it moves before we get a bullish sample, cover your calls, and then buy into it at the liquidity there. And you would want, there's just an assumption here, you'd want price to move back up and take out any shadow traders who weren't privy to what was going on here and tried to hold for a second leg, kind of like what happened Friday. In that instance, we could see a really, 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 really aggressive move up, because then you'd have not just people trapped for a couple days, you'd have some shadow traders, some very smart shadow traders being trapped out. So this is me just sort of extrapolating forward to give us a possibility space. And it's important that you understand that this is modeling out. You're not looking for a string. You're not going to say, if we take A and B, this is, what you're going to do is you're going to have to grapple with the idea that we're taking A and we're creating this possibility space, and we're trying to figure out if there's a zone out here and out here, that's better. And then those strings start to coalesce into reality. So that's what we're doing. We're looking at both sides. I think that the bears could come in and pick up some open interest and move it back a little bit, but I think that the scope of the trade really is beneath that size of a trader. If you're going to be stealing open interest off big hands, that you're probably very informed, and you're probably thinking like multi-day, not 10 points intraday for running into bulls. So if they did pick that up, what I mean, the bears came in, picked that up, and we saw that you really should immediately say to yourself, multi-day traders are picking up liquidity, and that should color the way you view how things are looking right now, big time. You see those multi-day traders coming in. And the thing to look for will be tension, because this is our we see the liquidity. You want to know so this pops up, hits that, comes back. We see the price move with a little bit of aggressiveness, suggesting they're there. And then you'd want to see tension, curl down. We saw the liquidity shift there yesterday, and that was interesting to watch. If the bears are going to come in, we're going to need to see that liquidity actually impact tension. That happens, you should buckle up, because that means that there's some big players who have some big ideas about moving down, and this could get quite contentious because the bulls are in from Friday, and they're holding, and they're anticipating wiping out this bearish arrogance and converting that arrogance into profits. Right now, I think that's exactly what the bulls are thinking. They're like, well, we just got to trap these guys out. but carefully, because if we're not careful enough, then trying to add liquidity, I might be being too abstract. These bulls here want to trap out the bears who tried to cash average here. And if they move too quickly with velocity or decay, right, to get a sample, then prices could move down and let those people out. So there's this finesse that needs to go on here. And this is not like a super rare situation. We see situations where the bulls or the bears are at each other's throats, and one side says, if we just are very careful, we can make this work. And if you've ever been on the wrong side of a trade, the market is very careful to optimize your progress. And that was the thing we saw Friday. It was converting. Let me write this down because all of you should have this written down. You want to convert a loss or a bad trade into hope, and then into apathy. So the way that'll work is I think this move down really did push people into being hopeful. They're like, okay, I was right. Things are fine. We're going to be good. And then seeing the nice slow grind up is converting these traders into an apathetic state. And apathy means that you don't feel the sting of the market making you wrong and moving towards your stop. That like sting that you're supposed to feel that's get you to stop out goes numb. And that's what I mean by this. So then what happens is they start to see things move and it goes up and you hear this phrase a lot. Let me just write it down so that you can write it down. Not an octothrope. Of course it goes against me. Of course it runs up. Of course it gets stopped. They start doing that. And it's a very like blamey statement where it's like, I'm never liable. I don't feel anything. It doesn't even hurt, so I'm not liable. And it's just finger pointing. So we get to traders to the of course phase. You start to see posts and stuff where people are like, no, I'm not wrong about it being short. Markets move up and you just don't know and blah, blah, blah. And it's very just like justify or like defensive. Or you'll get posts coming out of like media and stuff saying the market's crashing as it moves up. And then once it gets to the top, they start posting market's going up forever. So we're sort of in that phase right here. But the reason things are moving slowly, in my opinion, we have a little finesse that needs to go on. We don't want to scare these bears. We want to keep them in. Keep them in. Nice and slow. Get that hope over to apathy. The way you do that is you're like, okay, everything's fine. We're good. And you start taking it out of your mind. You start thinking about other things. A lot of traders will click away from their charts. They'll start like, searching the internet. And you're like, what are you doing? What are you doing? They're like, oh, I'm good. It validated me already. And like, you are primed for death. That's what it is. And then when they come back, this slow grind hasn't quite moved enough to scare them. And this is the magic. Are you ready? If you're stuck in the situation, if your eyeballs are looking way too far down, consider what your average trade profit is. If you're sitting here going, I make plus 10 points on a trade. And I personally like to shoot for 10 points. I think that's a good size for most market conditions and other reasons. But let's say plus 10. Let's say you usually get about plus 10 on a good trade. And you're sitting here going, this is going to go 100 points. Just right? So what's the first thing you do? Well, it's going to go 100 points. So therefore, I'm willing to use 90 points of my already gained profits in the future to risk with. So you think that you can move your stop around because you have some guarantee of that 100. And the way you do that is you're using the suspension of belief or disbelief. You're basically saying it's so good that you'll suspend the fact that you don't believe it's going to go there. And this is why profit targets are inherently dangerous. You're blinded by it. And so that's what these traders are doing. That's why they're such easy targets. That's why this narrative is going to work out. That's why they're going to get liquidated, because they're being biased and they're ignoring it. And we can see that. We can then build the structure and we can see, you can make rational assessments like, does it make sense to shoot the market down and sample bulls right now? No, because in order to do that, you're going to have to let those silly bears out. We don't want to do that. I don't want to do that. Getting the bears in further means liquidating or hitting those stops, which I think are sitting about here. And then these bears could come in, but they're going to be literally face to face with this idea from a few days ago, or from Friday, that the bulls are in holding. So we've got a little bit of a fight coming up. I think there's a lot of upside potential in the market right now, but it's not like the bears don't have any options. The overall bears. So you do need to keep your eyes. You can't just walk away and shut your brain off. We need to see how this plays out. The next event likely in this market is going to be velocity. I mean, look at how far decay is. That's a ways. Velocity's getting pretty close. 33, we could wipe that out. So you take 33 times by 20. You know this math, right? So we're at what, like plus 2,365. And we want to move this down about that. So it is like we'll just say it's around 600 for easy numbers. Let's say 645. I know that's not accurate, but close. We'll just get close to make this easy. So we just boop, 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 boop. All right, here. So what is that? 6, 4, 6, 7, 8, 9, 10. So 4. Could we do that? Could you see this hitting 1400 before the market closes and then rising again? So 1400 is just fine. At 236 down to 1400. Sure, it's a lot of a move or whatever. You know, my math probably isn't even perfect there, but it does. The point is, the idea is that we would still have a pretty high advanced decline. A lot of stocks still up. That's good. But having a lot of stocks up is supposed to inspire people to buy. A stock is up, buy it. So we still have a good chunk of stocks up, and we could take out the velocity, and we could get the bulls in. And if we do it carefully, we could do it in a way that doesn't scare the bears, and that'll optimize a lot of performance here. We can get some upside. Is it necessary? No, the bulls do not need to get sampled, but this is where you get sort of variability. You know, it's gonna vary. We can't know exactly what's gonna happen, but we can definitely say that the bulls could get sampled, and we can also say that they don't want to let those bears out. And if you don't know that for sure, just follow along for a while. This is the thing that markets don't like to do, and I personally think it's pretty self-evident. 660, Andy's doing my math for me. So I didn't even write down the number right, did I? I just did terrible math on that. I'm sorry. So this is important. We've modeled out our space. We know where people are. We have an idea of the psychology of the big players. We got an idea of what they're... Okay, so we're going to talk about one more point that I think is really important that we haven't talked yet because we really don't have any liquidity today. Tension. Look at this. So you can see right off the open, tension was sort of flat a little bit. And I think what was going on was that the bears were so enthusiastic to dollar cost average, they just got in. They just did. I think that's what caused that little blip in tension right there off the open. They were just pumped. I mean, that was the idea, right? And then you see the market sort of hang out and then drop. But that whole time, tension was just getting, the internal tension, you could see it was getting pumped. It causes a force and a counterforce. I'm calling the counterforce tension. The force coming in, the counterforce is coming down. And when you see tension rise, it's from an internal force. So if you're looking at tension, you can see the internal force here as bears tried to, right there. But then it just, right? So, okay, so what do these players want? What do the bears want? Well, be rational for a second here. If you're a bear and let's say your whole world is just controlling tension, do you think you're going to get tension to do this and the daily to do this tomorrow? And that will cause a trend cap. If you get both daily and 30 to cross over zero at the same time and move through, that's a trend cap, meaning it caps off the trending mentality. Like it's severely damaged the market for the major part. As a trend, do you think you're going to get that tomorrow? Just look at it. I don't. I mean, look at the last time that this happened. We had zero test here, zero test here, zero test here. Bulls haven't really shown, hey guys, I don't care anymore. Have they? So we see that the bulls are definitely defending daily tension. Every time we get it down to zero, they're not interested. So if the bears decided, they say, let's take a big old position here, and they're like, let's turn it down. Guess who can see that? The bulls. And the bulls are like, yeah, we're going to defend. I don't know why the bulls wouldn't just continue to buy, because they will defend at zero. They will fight for this. So it would just be absolutely terrifying for a large player to sell the market because the bulls have shown no sign that they're failing or faltering. You could say yesterday that 30-minute did get under. Fair. But I would also say they defended daily tension and it basically just trapped in bears. And I would say structurally, that was just a big lie used to trap in the bears. Daily tension never came down. It was a divergence. So I'm looking at this and I'm saying, I'm not really seeing the case for the bears in terms of their ability to control the market. I see the bears. I see what they're doing. I see their foolishness. I see what's going on with them. But you guys are struggling. Okay, so what's coming up next? I had to piece all that together. It took a while. So let's start thinking about what's next. I needed to because this is high-level complexity. You needed to have a long enough memory to be able to, I've been at this for a while, so I tend to remember events for like 5 or 6 days pretty well, all the events, just because I do it so much. It's not like a magic trick. If you stare at the charts every single day for years, you just can't do. So you have to have a little bit longer memory. And so I'm saying this is higher complexity because of that. So I needed to spend a good amount of time explaining what was going on so that you can get an idea of the model so that we can look at what's coming up. And then you can color this correctly and see why the market is going to act the way or why the market acts the way it does as we see events unfold. As you go, if price moves down, and it gets through and starts letting those bears out, and you see maybe like a news event hit, you'd be like, oh, I totally see why they hit that news event. They're trying to get out of their losing position. Yeah, duh. That's what I would do. If it starts to move up, okay. So what's next? What's coming up in all this? Well, the bears, let's talk about them first, since they're the most important party today because they're paying. The bears want one thing. They need bulls to fail. Okay, so if the bulls never give up any liquidity, and what I mean is that, what does this mean? You have, let's say velocity comes down and samples right here. Boom. We get trapped orders, something like this. Bars turn green right there. So we get our liquidity. And then the bulls, and you see prices come down and then prices just keep going. And you see tension just go, and you go, whoa, bulls, you didn't inject capital. Whoa, bulls, you didn't hit and impact prices. Sorry, I should probably line this up. You didn't impact prices. And then velocity just sort of maybe goes sideways and moves back under. What happened? And that would be failure. I'd say they failed. They failed to hit. They had control and they failed. And that failure would turn into motivation. I think this for the bears. Okay, this is an important step. And then 3, we have bearish. That says bearish. I know it doesn't look like liquidity. Okay, so first you see them fail. Then you see bears get motivated because they see it. It's clear to you. It's the context. And then we have bearish liquidity. This is what the bears want. Overall, they want to see tension get pushed down to 0. This is the whole goal for bears tomorrow. Can we get into a position that will let us shove tension back to 0 and possibly through tomorrow? Can we? Okay, so if you're a bear, what do you need? First, you need velocity to test 0 or decay, sure, but I mean, decay looks a lot farther away. So if this is what the bears want this, but they want it to fail. Well, more accurately, they need it to fail. Do bears want tension to curl? Not really. I mean, there's just not enough time in the day to really make an impact on tension right now. I think the big objective would be to try and get those bulls to get sampled. We need more bullish samples. The more bullish samples you get, the more chances of them failing and getting the bears in here. So that's what the bears want. So coming up for the bears in their world, their idea is to say, let's see if we can get those bulls sampled. How are we going to sample the bulls? Well, currently, if you sell the market, you're going to play into the inversion. This chart. You start selling on the market, I think it's just going to squeeze you. So you have this real big problem. I want something, but all of my actions work against me to achieve it. So you sit on your hands. That's really the only choice that they have. You could maybe take up options to hedge your losses against your but spreads, condors, all that stuff, none of that's going to make a difference at this point. You could hedge your losses if you're a bear from yesterday, and you could hope that these things, but then you're running into hope, and hope is a horrible trading strategy. Don't hope. You need to look at what's going on and make wise decisions, or rational decisions at least. Okay, so that's what the bears want. They want failure, because if the bulls fail, then tomorrow they have a chance to pump tension down. And their goal is to say, can we get this down to 0 maybe tomorrow? And that'll at least give them a chance to control probabilities. Got it? What do the bulls want? Well, the bulls, they just want tension to pump higher. I mean, let's see, that's really it. They just, we could see this. At some point, though, I mean, we're at negative 56%. That's negative. Why is it? Because that's the counter. We're talking about tension. This is the force, and this is the tension, the counter tension. So what do they want? Well, they want to keep things going up, but if stuff gets too hot, and what is too hot? If the counter force gets up to like negative 70%, I think that's very hot. We almost never see 80 ever. When the pandemic hit, we saw a pretty decent dip in tension, and I'm sure you can guess why. So here, getting to 70% would be very high. So if we get tension up to 70, and just take a look at the trajectory, and I put the projection on here. It's not perfect, but it's to give you an idea. I personally think this would go something like here. And I don't have the scale on there, but I can sort of tell 56. It's starting to look like 70 to me. 70, maybe we'll say 65. Let's say 65. This is looking to maybe close about 65. That's pretty hot. What does that mean? It means that all of your pushing up has this counterforce coming down. And really the markets like to burn through counterforce. So we got to deal with that. You get a burn-off day where the market deals with this. That's what a burn-off day is. No matter how it's structured, if you have high levels of tension and you don't at the end of the next day, you get a burn-off day. Simple. How that burn-off day works and the type of burn-off day has to do with what happens. But it looks to me like we're going to get 65, and we might have a mentality where it's like, hey, let's see if we can burn through some of this, because it's going to get really hard to keep pushing up if the counterforce is so heavy. So that's so what do the bulls want? Well, the bulls really want the market to just keep drifting higher, because if it just drifts, inversions don't usually impact tension that much. It's nice because people are just coming in and losing. They're just handing the trade off to each other. You sell, stop, sell, stop. You do that all the way up. And the internal market, so there's the market, the internal market can just sit flat while that you're stopping people out. And that really means that tension doesn't get pumped. So an inversion looks really tasty, in my opinion, to the bulls, because tension's getting high. And then tomorrow we might look at elasticity. Can you see why? If we can get the market to squeeze out all these silly bears, stop them out. It's explosive, it's dynamic, everybody's so confused. Oh, why? And then at the close of the day we go, oh, hey, we have a high level of tension. Well, at least not the close of the day, but after we do that, we say, well, let's see if we can get some elasticity in here, and the bears could have a chance to drive this down. And then everybody will be happy. The bulls will get better prices, they'll have lower tension, the bears get a chance to make some money. It's a win-win, right? So what do the bulls want? They just want to see this move up. And in some weird way, you might even say the bears might want that too, because the higher we get up today, and then if we have elasticity tomorrow, right? So it's not like, it's a zero-sum game. A lot of times it could be a positive-sum game for the players. It's just important that you understand what they're looking at. I just don't see a really good case for down. I don't. We just let this drift. We got a great situation for the bulls. They can make all their money and be happy. into the close, and then tomorrow we get some elasticity set up. We see the bulls fail, which is the nod. The bears get in, or maybe they already were in, and then they start riding tension down. And then we get things lower, and then bulls say, whoa, let's grab control of this again. And that's kind of exactly what was happening. Let's see here. You can see that it dipped down. Thank you. Dip down. Thank you. So you can look at it that way. It was the bears making some money, giving the bulls better prices to buy back in. And it just had to do with the way it was structured. So if we see this come down, I think the bulls would say, thank you. You know, it would look like that again. Unless something dramatically changes inside the market, that's what it would look like tomorrow. So can you see what the bulls want? They're like, well, we just want this to move up. We have trapped in some people. We did a bunch of work, took on some crazy risk. Just let it drift. And if the bears jumped in right now and they tried to buy up these stops, remember that there's sort of like three groups here. You have the bears here who are like the negative bears because they're inside upside down. Or they're trapped by their own silliness. And then there's these bears who are anticipating open interest theft that could, they don't have to, but they could. It's like an open door. They can step in there if they'd like to. And then you have the bulls who are just holding. And the reason that this hasn't really been clear yet, in my opinion, is because the bears wanted in so bad right off the open, and then it's like, well, now it's a long ways to sample the bulls. So we just haven't really sampled the bulls yet, or had an opportunity to even do it, just because of what the bears got themselves into in a sticky situation. So that's essentially where we're at. What we're going to be looking for is how the market reacts to data points as they come in. The next data point is velocity getting to zero, as far as I can tell. But currently with this trajectory, I mean, doesn't it look to you like it's going to get... We probably wouldn't get a bullish sample today. It'll just be upsetting. Either you were already in and you were holding, you never really got great liquidity, or if you tried to chase it, it could churn you out a little bit because of the way the market's set up. I mean, we have some freedom here where things could happen. But overall, I just don't see a great argument for a dive, because that would change the context. We need to see a bullish sample before the bears get... Well, we should see a bullish sample before the bears have even the chance to get their heads on to try and attack. I think a dive right now would just be nuts. It would just be an opportunity for bulls to pick up more contracts at lower prices and have a good time at the expense of the bulls or bears. So I don't think that the bears would get out. I think closing the gap would be just a huge waste of opportunity. So that being said, if the gap closes, I would take that as a huge data point, because we have, I think, a really good case for the bulls driving this up, inverting things up, getting things to rise, get to 30.25, sure, 30.30, just go as far as you can, because tomorrow I think the bears have some ideas. So it's like, just go, don't waste your time here. And so the finesse is going to be, I think, a tough one. If the bulls wait too long, we can see the market drift down, and sadly, it could be that the bears get too tired and they dump. I don't know if you've ever done that. You're in a trade, it's just not really working. You see what's going on, you get sort of bored, and you move on. And so I think if the bulls wait too long, that could be a bad thing, because we have these emotional bears and it's working really great in their favor. But if they go too quickly, they could scare them out, and it could change the narrative quickly. So got to be careful there. But I think it's going to be finesse. And I think if you're trying to take advantage of this, I would anticipate you need to anticipate some games. You need to anticipate that the market is going to try and play with you, because the goal here is to get people to sell in. So you see this like grind, and then boom, all of a sudden it looks like it's straight down, and then it slowly goes straight down. And overall, it was Simpson's paradox, right? Where you have all the data points say one thing, but overall it went the other way, or something along those lines. Or you have the sweeps, which is a knee-jerk on your inability to tolerate motions that are less than a 32nd of a second. So if it's a 32nd of a second, you don't have the ability to process, so you just propaganda process, which means you see the information And however you've been programmed to it, you emotionally react and do something sort of like propaganda. Like you just, whatever propaganda you've been fed, which I'm not using that in a negative sense, just in like the way you've been primed emotionally to interpret data sets before you analytically can assess them is equal to the propaganda. So it's like you see this pop sweep down, you'll react. So if you're afraid, or if you're like, oh my gosh, there it is, it's going down, boom, you'll trigger and you'll short right into the low and I'll just trap you. So expect some games. If you're long, you need to anticipate the market will game you as much as possible, partially to shake you, but also to bring in as many shorts or sellers. I wouldn't call them shorts. I wouldn't call them shorts. I'd call them sellers. Well, they're sort of same things, but like I'm distinguishing here that bears consume liquidity, have equity. Sellers are people who are retailers with lots of margin. I tend to associate shorting with bears, and sellers are just liquidity. They're just like a product that you get. So I think the goal is to bring in that product, the sellers. So we've got the scope here. We have the landscape. Now we need to observe how events happen. One of the big issues that I'm dealing with right now when it's like, how do you engage this? Is that we only have really one data point today, right? We just have the one, which is this. The decay retest where the bears tried to cash average. It's really, I don't see a whole lot of anything else. There's no liquidity samples, there's nothing. It's just a very empty day. And if you also notice how long it took for that sample, this is something that I'll kind of look at, like 2 hours. Sheesh, 2 hours. Remember this day? Bulls, bears, even a potential bears there, bulls. It was like a ton of samples and ideas within the first hour. It was like so active. And this is like, it was a little bit of a void this morning. And I think it was just the sheer enthusiasm of the bears. So the reason I point that out is because markets that don't do what you want will bore traders with money, and they may potentially just walk away. And that's something you need to think about as like a meta. You know, if you sit down and you take your hard-earned time and you're like, nothing's happening for hours, a lot of people just walk away. And that can be a good thing in that it creates exclusivity in the trade because everyone just walked off, that only few people take it, so it performs better. But in this case, we're not getting even any more data points. Like the next data point's velocity, and that could take us another hour. And we're running out of time. So it's like the data points are getting sparse. This background concept we have of bullishness is still here. It's looking good, but we can't really test it or challenge it without data points. And so as much as I want to participate, I don't have data. I need more points. I need more things to verify or discredit expectations being met or not met. And it's like we just got the one, bears scrambled. That's all I see. I just see that. And then we built up our little world here around that so you can see where it is. And hopefully you see that. I mean, hopefully you can see how that we built this up. Hopefully you can see why. I hope that you have a general understanding of why I think that there's not a great case for bearishness, but why I'm not super active about it, because of the data point problem. You just have the one. And I don't think the narrative's wrong. I really like to see a couple of points of data before I get willing to act. And maybe that sounds a little conservative, I suppose, to say I want to see data points. But it's not that I want to see price moving advantageously. I'm not interested in that. I mean, I am eventually, but price moving favorably for my idea is not what validates my idea overall. Unless price moving favorably is a component of the analysis, price moving favorably doesn't make you more or less right or wrong. It's whether that your points are being validated and you're using that a process to constantly update, sort of Bayesian, I guess. You're constantly updating what you think based on expectations. You say, expect this is what I got, I expect this, and you keep going. Eventually you get to the point where everything just lines up and it goes. And the issue that a lot of people run into is by the time that things line up, they are doing something else over that moment. And it's so consistent, I assume it's just part of the framework. So if your objective is to just sit down, see the obedience that you need to have. When do I obediently click a button? When do I obediently put a stop? If that's your goal, you're not going to be able to see when it happens, because clarity is something that you experience in real time, and it's almost impossible to see retrospectively. Because everything's clear in the past, you can't see when clarity cycles high. You can just see clarity all the time, and it's like you're blind to it. But if you experienced it, you could say, well, clarity was right here, or it was really confusing here. But historically, you can't see that. It's like it's just void. You're blind to it because it's a social intelligence thing. I think that you can only experience in real time. You just can't do it. Now, we've gone through this. What my plan is in this situation, I have a bullish mentality right now because of this context. You could see how I think it's going to play out. What am I going to do? Wait. Unless you're in a position from last week, Friday, we haven't had a clear-cut spot where the bulls were seen expressing themselves. You could use your tools and sort of keep a bullish mentality and say, well, I'm looking for signals that sort of look at the bullish side. I think that isn't a terrible idea, but you need to make sure that you're constantly updating your narrative so that while you're looking for whatever method is that you want to use to engage the market, that your method isn't giving you signals at a time when the narrative is updating. Because you can't get stuck in the bind where you have this wonderful signal by your system and the narrative has just changed direction and you're blind to the narrative because you're so enthusiastic about the signal. Narrative needs to come first. So I tend to avoid signal systems because signals have this way of being more appealing to my brain than narratives because signals have this implicit guarantee to them. There's like structure and safety, and I feel like signals have the same problem options do. You think that you can buy into an option and you're safe, and so you don't worry about it, and you tend to lose a lot more if you're trading with options because of that feeling of safety. You think it's safe because it's knowable, and it ends up being significantly less safe because it's knowable. It was the knowableness that made it get optimized out by markets. So I like to look for narratives, and then I just like to wait for what makes sense and then see some conflict, and then you're like, there it is right here. And then you try to take advantage of a narrative that you see going on. You try to get in somewhere that's advantageous because some conflict happened and you're like, oh yeah, this is great. This is how it's going to work. And then you try to just take a reasonable profit. I love to get out way too early because my probability of getting out with a 10 points on a 100-point move is very high. My probabilities of getting out with 50 points on a 100-point move is not nearly as high. You think it is until you try to do it. And then you realize that your probabilities of actually getting out with the amount you're trying to get, even if it's less than the total move, is not 100%. It just seems that way. If you don't believe me, just try it. To get into a great move, try to catch the whole thing or a large amount, and you'll realize pretty quick that over time, over many iterations, that going for the whole move tends to be a losing strategy because you'll get out too early and you'll take full losses. So I trade the idea, whatever my idea is. That's what I do. I'm an idea trader. I look for the idea, get the narrative, piece it together. Currently, my current idea is that the bulls have a better case here, that the bears would be walking into a trap. I think that if they were to sell this down, they would be basically handing the market to the bulls, who would probably pick it up, try and blast this out the high, get tension as high as they can, run some elasticity tomorrow. So I think that there's a better case for the bulls because the bears just whatever, and they got trapped in anyway, and they're silly. Like, markets don't give you money back. I don't know why the bears would permit that. They have control of tension, so they're the controlling party. So that's where we're at. If you can understand all that and you're keeping up, I'm really glad. I know this is very confusing and likely a lot of people have lost. It can be all over the place, but just remember, this today has been one of the most complicated days we've seen in a while because it took an understanding of previous days and stuff like that. So this is high complexity. Usually things are actually more simple, but the data points are all the same. We're always looking for liquidity. We're looking for decay retests. We're trying to pick out mental models, emotions, where people are at, what they're wanting. We especially looking for motivations, where you're going. And that should be the bedrock that everything's built on, is I know what people are doing. And I think we have a really clear idea. I think actually it's pretty clear what's going on here. The only issue that makes me not be like now is the fact that the bulls don't have a sample today. It's just one data point today, and that feels very low activity. Doesn't that feel? It's like low activity. It's like, what? Why are you guys not doing it? What are you doing? Where is everybody? I don't assume that the fact they're like, this is important to understand. I assume that the amount of times that we get liquidity signals is intentional. I don't assume that it's coincidental or happenstance. It's not that they say that there's a large institution who calls down and says, I need some liquidity, I pay for it, I want it at this price. I think when we get there and the liquidity is generated, it was intentionally generated, not happened to generate at happened to be that price. So I think that things line up right where they're supposed to line up. So we get a bunch of data points, as long as there's not too many data points, like we get that like 7 or 8 over like a half hour. It's like it's just noise. It's just too noisy. Then I assume that those data points are essentially essential. And today we have just no liquidity and one bearish risk reduction right in the middle of the day at the worst price area of the day. So it's like, why does anybody want to participate? So that makes me a little weary. I'm just like, so I want more data points. I love data, a couple of data points. I'd love to have like 2 or 3 so that I can say, see what the bears are doing, see what the bulls are doing, look at how their dynamic is, what their possibilities were, their liquid, you sort of model it out. And then you get an idea what's going to happen from there. And it usually is pretty clear. Like your conclusions, in my opinion, your conclusions shouldn't be A plus B equals C. No, it should be, it's obvious. It should sort of like have this on its face obviousness to it. So there's enough complexity. Complexity is high enough. That means data points and stuff. That the obviousness, so you don't want obviousness to be based on no data, like no participants. So you get 2 or 3 data points or 4 data points and it becomes obvious. You have plenty of data points, you've got a good narrative, and it's sort of obvious to you what's probably going to happen. I mean, if we had 3 or 4 data points, I'd be long already. We only have the one. And so I'm like, I like it, but I'm being picky, Picky. I want more. Give me more data points. Give me just a couple more. It's really hard to use any like statistical deviation models to make assumptions about populations with one data point today. You could also use the data point saying that the way that the market reacted to that data point could be a dependent data point. And I think that way. We had the bears. I keep drawing in the air. It's like I'm drawing in my mind alone, and you guys can't see. So we do have this one data point here. The bears try to get into a risk reduction. And it's like you could look at it and say, oh, well, look at how it reacted, And you could take that as a data point. That's fair. I think that's fair. It's fair to say. But risk reductions are not my favorite data point. I like liquidity. I like to see how it react. And you can see tension it's just doing that one thing today. So it's hard for me to say that this whole thing implies that things are going to shoot up. Like when I look at tension, it's moving in one direction through the day does not mean supply. I mean, we could see that it was moving up. We can. What's really happening is we're limiting our upside. And look, price hasn't moved a whole bunch. We're limiting the upside because too much more up could cause this to get too high. And the moment when it matters is when we have liquidity happen, and then we see how that liquidity impacts the probability. So it's like saying, how do your actions impact the future of this market? and if you're a big player and you do things and it causes things, I assume those causes were intentional because you're a big player and you can afford to understand those causes. So I assume if we get bullish liquidity and this continues to move up, that's intentional, and that the bears are completely aware of this. So that's where we're at. There's really not a whole lot more to say. I mean, this is just a waiting game. Either you have some system that you're using to try and take advantage of this. And if I were to just, if somebody said, what would you do? I'd say, well, I would try to get a position a long position as close, somewhere in here, as close to this price or at those bear. I try to get a long position as close to that as I could. But I mean, that's, I don't know what to tell you. Like, either you got in or you didn't. And getting in now requires you to have a stop. You're going to have to share your stop down here. You're not going to be able to put a stop in here. You instantly are going to become a target, especially if more than like 5 or 10 contracts. The market's going to go, oh, there's a couple there, there's a couple there, there's a couple there. And if we have bullishness in the market, I mean, it's still got a little while of fiddling around before anything's necessary. So I'd say just try and get as close to there as you can. Trying to take any losses because this could have some teeth. That's about it. I'm not sure there's much else to be done at this point. I think the interesting day is going to be tomorrow because we have our tension number getting up pretty decently high, and we want to see if we get. I mean, you see Wednesday, and yeah, we had some messing around Thursday, but conceptually, if you looked at that and said this was a burn-off day, you can see this works. So you got tension up, and then it cooled off. That's what a burn, and we're getting tension up, and we get tension to cool off would be a totally reasonable thing to happen, especially if it provides advantage for both sides. So right now, I still think up makes good sense for both sides. I also think there's a lot of people who are eyeballing that gap. Like a lot of people, I think a lot. It's one of those data points that's so bright because it's so big. It's really hard to see. It's like a really bright light in your eyes. Like it's like hard to see anything else, especially if you're aware of it. Then I think a lot of gappers, I call them gappers. The gappers are going to be just like, oh man, and that's difficult because when a profit, like I said, when a profit target's too big, you suspend your disbelief. You say, I don't know that I believe I'm going to make 100 points, or let's see, in this case, 50 points. But it's so bright, you just suspend that disbelief and you go, I'm going to make 50 points. And then you're like, so I could have a 30-point stop loss because I'm going to make 50 points. I don't believe that, but I'm not worried about that right now because, boy, is that a pretty profit target. And that's what they do. That's what you've done. We've all done it. So I think the gappers will probably help into this because, yeah. So overall, bullish, but you need to be aware that we don't have a whole lot of data points. We're looking for an inversion, so make sure the tick stays down. I'd love to see the tick pop up and push a new high pretty soon. I think last time I was streaming, I had that up, so I'm going to put this up right here. You guys, or let me adjust this so you get an idea of the volume profile. I'll stand in the way, and then I'll turn this on. There you go. So the volume profile, I know it's probably pretty small, but at least it's up there. You get out a magnifying glass. So I don't know. I'll zoom this in. Well, you can see. There. So it's sort of lined up so you could see. Okay, so you get an idea. Now the goal is to keep the tension down while prices rise. Okay, so you know where everything's at. There's not much more to say. We could look over and verify any activities on auxiliary markets. So if you're anticipating, so yesterday we anticipate that bulls bought, right? So you want to see money coming. Sometimes I get this upside down, and I think I may have gotten it upside down the other day. Yes, Friday. When you buy into equities, you're taking your value out of the dollar and you're creating supply because you take the dollar skin off your value and you give it back. You take it, you stick it into equities, right? So then you get this supply. You get the dollar going down because people are pulling their money out of dollars and converting them into shares. So supply. And then if people start taking profit, they're taking the ES skin off their value, and they're taking the dollar skin and put it, so they create demand. And it tends to be that the dollar is really good at front running that demand. It's suspiciously good, in my opinion. So what happens is, if they know, the market seems to know that you're going to want to you need a bunch of dollars, it's going to drive prices up. And then you're going to start putting those onto your value, and it's drive prices up. And then that proceeds, and then you see the take profits happen, and it continues up. Basically saying, let's give you the worst price possible. Same with the other direction. So we can look over here. I know my head flipped around. I need to flip that. And look at, here's the dollar. Look at that. Boop, it's coming down. So people are taking their dollars, they're pulling the value out, giving the dollar back, just creating supply downward, and they're taking the dollar and sticking it somewhere else. And our assumption here is that there's a bullish case and other things like that, and it could even be bears are trying to take some capital and put it to work for the bear side. But I think there's bullishness in the market here. And so we could see that dollar coming down, and you could say they're taking money out of the dollar and putting it somewhere else. And then you sort of look around the market and you say, well, where else? Where else do they put it? You can also do that with some of the other things, but yeah, I really like the dollar for major, a little bit longer term trends in that model. So we saw the dollar is coming down a little bit. So that's kind of hopeful. You say, was there money being injected into stocks here and stuff like that? And you can look over the market, and I think the context does way better than looking at any, like the advanced decline or something, or Vold or whatever. Those don't do as good of a job. You get the context. We see the bears are trapped. The bulls have some ideas. So I think this context gives us a better scope. Better if you're looking through a magnifying glass here. Sitting here, this is giving us a better view of the bulls or bears are here. And then looking at the dollar, boom, we can see it. It's like, oh, they're pulling money out of the dollar to put where? And then you come over here, we see this context. We say, here, this is where. So I think we got a good view here. I think we figured this out. I think it's just going to take time. I think it's going to be likely irritating, and it may even wait to the last minute to do a whole lot. Another philosophy that I think would be important at this point, especially if you decided to take up a position based on this analysis, I don't consider wiggling around in a range to make an idea right or wrong. So like I look at this and I see, if you had gone along here or even here, and you're like, yay, sort of. I mean, until this really pushes out the high, and then we see the tick behaving properly, and if we can get an inversion, it starts to maybe move up a little higher. I think at this point, I would say, okay, the idea is good at that point. And the reason I do that is because if you sit and you think that 1 or 2 points in your favor means you are right, you're stupid, is what that means, is because your stop is still at risk until you know you're right. And that's important in one situation. It's important when you're in a trade that moves favorably for you, but not favorably enough to confirm or validate the idea that you're trading. And then you'll make this mistake. You'll say that it moved positive, therefore I'm right, therefore I could put a break even on it. And what happens is that you're selling yourself short. You need to say, when would this idea end up working out and being correct or not correct? And then once it gets to the point where that you're like, okay, clearly this is validating my narrative. At the point where that it shows you that data, then you put the break even on there. Otherwise, I think that if you see so the counterpoints, the ones that scream in your face to tell you to close, price moved, signal, level, all these things, they'll scream at you, and they're hard not to see because you're holding a position carrying risk, so everything's sort of augmented. A little tiny thing becomes like a mountain. That if you're not understanding what makes your trade work or not work, you're also not going to be able to understand when a trade is working and not working. I mean, that sounds very like duh, but buying into a signal and waiting for a take profit means you don't know how your trading strategy works. And so you can't see in the middle what makes it work or not work. Your inability to see that is a function of whether you understand how it works. So if you're trying to put a break even onto a trade too early, you're misinterpreting that your trade hasn't worked yet. Sure, putting break even, it might be okay. That's fine. People don't want to lose money, but you need to understand. I'm not saying you have to do that. I'm saying that if you don't know when your trade is right, and in my opinion, it would be getting through the stops, seeing the market invert. I would love to see the tick push a new high. That's that chart right over there. The tick push a new high, ES continue up, run stops after that would be great. It's getting close quarters here for that though. And then I would say, okay, this trade is working. We're validated. You could potentially say that the bears got a risk reduction into the low and that destroyed them and that validates it. And I say, yeah, I actually think so. I think that whole situation was just terrible for the bears. I don't know why they did it. And you could use that, but I think that it better would be to involve more people than just one little group. Like you want to see multiple groups playing into the narrative that you think is stringing along the market. And in this instance, I would love to see if I had a position, I would say I would, until I see a counter position that suggests the bulls, remember what the bears wanted? Bulls failing, bears acquire motivation, and then the bears try. So until I saw the bulls fail, I would think this narrative is likely to continue to play. I mean, I don't know why it wouldn't. If the bulls were getting sampled right now and failed, I would say, oh, this is trouble. And then I would have to consider, is this teeth? What kind of trouble is this? Where it would bring up a whole new set of arguments that could take an hour to work through. But in this instance, I'm sitting here going, until it either works or gives me data points that change the fundamental narrative, there's no reason to change your direction. There's no single data point, in my opinion, that could really change the narrative at this point in the game. And that, in my opinion, is resilience. If you have systems that fall apart quickly, or you're like, oh, one price move could change my whole story, you don't have a very resilient way of thinking. You've come up with a very flimsy way of thinking, and it's very easy for the market to convert that into liquidity. I'll just push price down 2 points. That's all I have to do. It's simple. But if you need to unwind like the whole New York Stock Exchange in order to change a narrative, and that narrative has some basis in real large institutions, that's a good narrative because it means it's going to take more than a couple of minutes or even an hour or two to change. Right now, I think that it would take a lot. I think it would take a couple hours to change this narrative. There's not even enough time to change the narrative. An hour and a half isn't enough time because we have to sample, see the failure express itself, which I think would actually have to be pretty aggressive because tension would have to stop rising, and then we would have to see the bears acquire motivation, reestablish themselves, which would and get liquidity, which would mean that velocity would have to probably dip under and then come back up. We'd have to see tension start to curl down. Then we'd have to see the whole market cope with the fact that we're about to close and the bears are upside down. And I honestly think that if bears were able to step in right now and pick up liquidity, they'd probably just get their faces ripped off. That's what I think would happen to them. We have bears trapped. I mean, this is like the best. It's the best. It took 2 days to build this position, and now we have them. So we're just sitting here waiting, and we've got this carrot. We know finesse. Take a little finesse, bulls. Take your time. It's okay. Take your time. Just don't screw up. So you have character. We know the market's going to game you a little bit because the market really needs to suck in a lot of bears because we want to create this like capitulation where you sell, and then when you stop out, I sell and take that position from you. And it turns out it's just one string. It was just one contract that got written here. And it was just passed back and forth. You think you're opening a new one, but really you're just taking whoever just got stopped out. And then, maybe the broker picks it up at the high and then pens it down lower because it starts to move down a little bit. It's endless stream of contracts as it moves. That's the objective, I think. And then we hold on to that. And I think 30.25 looks good. I don't know why. 30, basically 30.20, 30.1975 is the overnight high you could see right here. or you can't see. I am looking at it's right here, looking at a totally different chart. I think that is a decent. I mean, we have an hour and a half, and I think that we should spend some time grinding, turning bears into apathy. Then we need to spend some time moving, and a lot of that movement can happen very quickly into the close. You have ramp capital show up or whatever. But in this instance, I think it would just be how optimized can we get those stops to be as a function of time into the close, and we want to shave off as many bulls as we can. Because the more people who are long right now, really the more limited the speed is. You're going to slow it down because you're withdrawing too. So it's like you fill, then they need to find somebody else to take the side of the trade to deal with the inversion. And so you see the market pop down. It's like, well, maybe instead of finding them somebody to pay them, instead of being directly against a market or a broker, we could just scare them out and stop them out. And I see those I think little pops down do that pretty well. A lot of smaller retailers will knee jerk to just a 2-point sweep. So so that's the situation that we're in right now. You have to deal with that. And if you don't understand, for me, one of the most beneficial things of this situation is that if you're going to take up a position, you can understand what's happening. And so as things occur, you can cope with them. You can also make rational statements like, well, where would be a good position to be? Where would be a good stop because of this idea? Or where will events happen? Where will things get excited? Or why? You can answer all these like qualifiers that most of the time 99.9% of traders can have absolutely no idea what's going on. Any system based on backtesting or statistics is essentially, I don't know what's going on. It's you're leaving the knowledge or understanding up to something else. If it works for you, it's fine. But in this instance, it's like, I know who's where, what they're thinking, and kind of the mentality they might have, and understand them. And so I can get an idea of what all these little things mean. And I think that you need meaning. You need narrative. Human beings are incredible at gossip. Like, we love stories. You can tell a story, it'll get told 30 times. And sure, it might be a little different at the end, but the point is that it gets told that people love it. You need a narrative. And I suppose that if you have no narrative, you're lying to yourself. You always have a narrative. Everyone has a narrative, always. And the simply not true that you can trade without emotions and without a narrative. It's just simply not true, unless you're automated trading, in which case you're just doing this and you're like, because you're letting a machine do it. And if that works, that works. But if you're going to make discretionary choices with risk and a really good Sharpe ratio, high probability of success kind of thing, you have to understand what's going on with people, and then you can make decisions. And the hardest thing ever is to feel like you're a member of a group and that you're important and that your decisions matter and that you're real. And most people feel like they're an outsider, they're an auxiliary, they don't matter in markets, they're too small, and they're just invisible. And that's just stupid. I mean, you're an important member of this group. You can understand what's going on. Just because you're at the stinking top doesn't make you smart. I think it makes you dumb. People at the top are dumber than you. They have there's no stress on their system to become intelligent. If you're at the top, and especially if you're at top collecting commissions and being profitable isn't even important to you, you're just trying to maintain some level of risk without taking losses so that you can collect commissions, especially off the retirement generation. You're a dummy. You're a big fat dummy, and you're easy to beat because you don't care and you've never cared. So you can beat the people at the top because they don't have adversity as a teacher, and adversity is the greatest teacher in markets. You need it. It's what makes you wise. So we can see what's going on. You can understand the players, and that gives you an edge in the market. You understand them. You know where they are. You know what they're doing. You feel how they feel. You get why they move their stops. You get why they took profit. You see why they're scared. And we're not talking about retailers. We're talking about the people who matter, the big boys, the ones at the top who have drug problems because their hands shake because they're insanely insane. They're insane people, if you ask me. They do insane things, and they compare their bonus checks, and that's about it. They all just like to see who has the biggest bonus check every day. And that's it. It's all that matters to them. So I think Goldman Sachs Japan. Leave it to Japan, I guess. Anyway, enough of my vent. I'll drink more of this Red Bull. So we're here. You got your ideas going on. I hope everybody can understand the context. Sorry, that Red Bull was really like bubbly. It's making me cry. Python. Maybe you need some server processors, probably a ton of them. That would be pretty crazy. So we got the context. I hope that you guys can understand where this is, how this is built together. You can see the pieces. Now, over the next little while, you're going to need to watch it play out. I argue that if you can't see this type of, this method of analysis actually work over enough iterations, enough times, you believe that it works, I argue that you can't use it. I think that it's a function that being able to do it has to do with your being able to believe that it works, because it relies so heavily on like the social parts of your brain. It's not that it's like a cult thing, like a religion that's like you have to believe. You know, I'm saying that I don't think you'll take it seriously unless you have enough evidence in first-hand evidence that it works over a couple of iterations. And so if you're like, well, I see what you're pointing to, I'm not sure what you mean, or if you're missing those data points, okay, I understand, ask questions. But it is important to note that from what I can tell, that it's your ability to see what's happening and then to believe that it's real has to do with if your social brain turns on to look at it. This just seems to be how it works. It's sort of like if you're if you call into like a call center, customer service, the moment that you are suspicious it's a robot, everything changes. You're like, hey, blah, 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 blah. And they're like, how can I help you? And you're like, this is a robot. It's like the whole world, the whole world changes. And so it's a function of believing that what you're seeing is actually people and not machines. And it will change the way you see them. And it'll help you go, oh, you're this and you're that, and you're real and you're real, and these are people and those are people. But if you think it's a robot and you think it's all fake, then you interpret it the way you interpret a call center robot. And it's like, you just can't make any progress with a call center robot. First thing you want to do is just make it do something dumb and trick it or something like that. So that's a big part of this. You need to see it work and how it functions, and that in doing so, that experience, and that it's a positive experience. You can't have a bunch of negative, you might have a negative experience once or twice, but you're going to have a bunch of positive. Then it'll allow your brain to turn on that social part of your brain that allows the analysis to actually work. But until you do that, and you're sitting there looking for like Markov chains, which is like this and this and this creates, you're missing out the whole point. The whole point is that you see two people in a room, you see them talk to each other, and you go, I understand. I know what's going to happen because I can see these people engage. It's a social intelligence, it's not your ability to analyze patterns and stuff like that. It's your ability to analyze people. If you're terrible with people, you'll probably be terrible with this method of analysis. This is a social game. The analysis today was heavily based on the fact that the Bears screwed up. They made a bad choice. They got trapped, and then they chased into the market. They grabbed a risk reduction. They're trying to save a bad trade, and it didn't work, and it looks really bad for them. And so you'll see things happen, and if that's really what you're seeing, then you go, oh, okay. And then you can start modeling what's probably going to happen. And it's amazing how good people are at figuring out what other people would do if you sit and watch them. You're like, oh, yeah. I see you did this, you said that. He said, oh, he's going to get mad. How'd you know he's going to get mad? It's like, I just knew. If he gets mad, this is what's going to happen. There's a gun on the ground. You start seeing what's going to happen. So I think it's important that you do your best to follow along the narrative, figure out what that means in the market, and then see how the market reacts to that narrative. Like it's not that it's going to say, here's truth and free money. It says, here's what's going on. And then you watch markets react and go, did it react the way it should in that story, in that narrative, that context? And if you're constantly seeing the market giving this interplay, and you get comfortable with that, and you see that it creates the fundamental backbone for market analysis, all your other tools should work great, as long as that you can keep together what's going on. If your other tools start overriding changes in narrative, you start choosing signals over sensibilities, or signals over data points that change things, you'll start to run into issues. Not necessarily that you'll lose money, but you'll run into issues in that you're training your brain to choose lazy idleness over engaging the market as a real member of this group. It doesn't work. You can't be an outsider in this world. They sure do. I don't backtest things. I build things to, I've built all these things to attempt to model things, very specific things. They're just models. I'm like, well, I want to see something, and math is the tool you use to know what you cannot know. So this was an endeavor to use math, and basically just use math to know things that you should be able to know out of a data set. I mean, that's it. And that's all really any analysis is to try and pull out more knowledge than your standard sensors like touching and looking and hearing can get. And if I found tools that modeled aspects that I thought were useful, I would totally add them. If I thought there were aspects that gave me information about the major players, so I could know anything. The secret key, I would know the intent, the actionable intent of the institutions and the banks, what they plan to do, not what they're doing, what they plan to do. Because that would let me engage when they engage and do what they do. I wouldn't actually care about what they have done. I don't really care what the past is like. I just care about what they're doing right now, or what they plan to do right now. And I think right now it still looks to me like we're just waiting for more data points. This is sort of frustrating, in my opinion. It's just sitting. I want like 2 or 3 good points that really express what they're doing, so that I can essentially extrapolate their intent and make assumptions, and then verify or unverify, and essentially make them a hypothesis until we have a theory, and so on. So, okay, so right now we're seeing some things happen, and we'll take a look at what's going on here. So, so we're getting down. So we're at that 3005, big pretty number, 3,000. People just love these numbers, and you can tell if you pull up options. People just love big round numbers. 3,000 is the best. Everyone trade options on it. It's like, why is it any better than another one? Anyway, so we have this coming down. You remember, this is our almost at 3,000. Look at that. It's almost at 3,000. What do you think about? Right about 3,000 is about where that position is. So the market's leaning down. Now, keep in mind what this means. If we get down here, what's the market doing? Okay, and this is a big deal. It doesn't have to do with anything that's maybe that you would think is groundbreaking, but for me, it's like, what are you doing when you do this? If you remember the models we were looking at earlier, it was like, well, if we accelerate velocity down a sample, what's that going to do to price? It's going to cause it to move down, and it's going to be looking to let these bears out. So what is the market doing? Isn't it looking like it's trying to bring in those bulls? Isn't that what it looks like? It's coming down. We're getting a little bit of, you kind of see it's starting to almost move down, like it wants to maybe go a little faster. But look at what price did. It came right down with it. It's like the bulls are going, ah. That's the way I interpret this. This comes down, and remember, the goal is get as close to their position as you can. And then you look at what's happening. You're like, well, under this context, it looks like we drew ourselves closer to getting the bulls in, right? So, well, what happened when we did that? It was like, oh my goodness. Not only were we drawing ourselves closer to letting the bulls in, we were also drawing ourselves in closer to letting these bears potentially hop out of without a loss. And you should be going, I don't like that. For me, it's not a function of true or false. It's just I don't like that. I don't like that you're trying to let the bears get closer. It's like don't. So if we get down there to 3,000, and I don't know that we will or we won't. There's a lot of freedom here. For the market to do what it's got to do. But you should consider what that means in this context. So for me, like I see this move down, and it's not that issue with the move down. Oh, it's just I'm sitting here going, why would you do that? And I remember on Friday, do you remember Friday? If you weren't here for Friday, not yesterday, Friday. You probably remember that. Let me show you. Down on the lows, you can see right. We had a good bullish position. I'm not going to go over what made that whole situation, but then it came back. And it came back again, and I hated that. It's like, oh, you guys are so ridiculous. It's almost like they're doing that again. Bulls. Anyway, so I sit and I look at that, and I look at how it's not that it's making me, I don't like it because it's a failure by the bulls. Because the bulls have a great position. It's that you're inching your way towards something that could be more trouble than you want. And the more that the closer you get there, it's just like if we get too far down, we could see some executive action by the bears, like we're close. And then they hit that button because you can't assume that just because you're losing means you can't flex. I mean, this is a game, and you play back and forth, and your objective is pretty simple. Use as little as money as possible to make as much money as possible. Reduce your losses and add to your winners. That's it. One of the pieces that most people miss is reducing the amount of money to make while making as much money as possible. A lot of people think that we have $1 million, you should put $1 million on the table. It's like, well, I think what an institution would like is to have $1 million and put $10 on the table and make another $1 million. That would be great. So you want how much capital? So institutions will choose to exit their position because it's it's requiring too much capital and it's not winning. So when you get into a winning position, you want to add capital to that as little as possible to optimize the profit. So it's this game of don't use money, but make it. And so when you see this move down here, so you're going, you people in your optimization algorithms make me nervous because if it comes down, it's not that the bears couldn't shove it. It's not that they don't have the money. It's just in this game theory style game, it may end up being that injecting some capital to bring things down far enough to just get out could topple short term, maybe over an hour or so, topple the power of the bulls. It's because the bulls would say, well, we don't really want to counter that. That's a lot of money. They really want out. Fine. You can have out. Fine. And that's what they'll do. That's what they do. They don't actively punch each other in the face till they're bloody. That's what they do in MMA. In the financial markets, they go, if I win, will you win? If you lose, can you lose as little as possible so I can win a whole bunch? And they I think they work together. In fact, I don't actually think the bulls and the bears are different people. I think they're the exact same person, but we're distinguishing between two faces of the same person so that we can see how they're handling each side and the money and stuff. And I think really, if you want to be at the top of the food chain in the financial world, you play both sides all the time. You're always on two sides of the fence selling guns to the bad guys. Always. You never pick a side. Picking a side is doom. So I think right now where we're at, we have those, it came down. Did that concern you? How did it make you feel? Considering this context, look at the context, look at where the bears are, look what the bulls are doing, look at velocity and say to yourself, if I was a bear and I saw that, and then look at it and say, if I was trying to sell into this because I just knew it was going to crash, how did that make me feel? What did I do? What did that change for me? And then look at it from the bull's perspective. And that's immediately what I was doing because I think this is bullish, and I tend to want to focus on the winner. You can't ignore the loser, but I tend to initially interpret information from the winner's perspective, not the loser's. And in my opinion, this is a continuation of Friday, not a real new thing. And so I'm looking at this from that perspective. I see that move down. I say, well, the bulls are, this is a bullish market, it's a bearish, silly. So I look at that, and that was initially how I interpreted it. That's why I'm like, you guys. So consider it from all those perspectives and use embodiment. Become the bear. Let yourself remember what it was like to sell and be trapped. And look at that and say, how would that have made me feel? And you do pretty good. You'll do a pretty good job. You'll say this and that. You'll come with something. So how did that work into this? What's most likely was the objective of that? Is this the bears coming in and pushing the market down? And if so, which bears and where are they from? And are they winning or losing? What's their goal? I don't see any initial bearish positions. I see that upside down risk reduction. That's all I see. So I don't see any bears. So I'm not entirely enthusiastic about the idea that that move down was anything to do with bears. If anything, it had to do with bulls. Can we limit you? And we got a single sweep dip, right? So it sort of pushed through that. I need to draw if I'm going to talk about this. So that here, see this sort of little range here, right? Break out the high, break out the low, irritate everybody, right? And the rule here is typically, how can you ruin everybody's day? That's a good rule of thumb when you get into situations like this where you're sort of waiting and you're trying to model possibilities when you have sort of a wide, I mean, we have kind of a wide area here. The market could do whatever it wanted without really breaking down the structure, right? So typically the best way to go get about this is to say, how do you ruin everyone's day? And that's going to end up helping guide optimization, in my opinion. So we have somewhat of an expansion bar, I'd say about here. So about VultiWap right there. That's going to be about an expansion bar, maybe a little below that. So we could just key in to VultiWap to tell us where that expansion bar is. Secondly, something we can do, and this is useful, just basic analysis. If you had bought at any point through here, okay, where would you have put your stop? Don't ask yourself where you would put your stop. Ask yourself where you would have. It's totally different conjugation. Where would you have put your stop? And that's, if you're not quite sure, just look at it and say, where's the safest place without too much risk, right? And I think it's pretty clear that this would be the initial spot. If you had bought into here and you saw all this stuff happen and it popped up, you probably would have popped your stop here, but then as it came back down, you would have had to massively choose. And many of you maybe even did. You had to you were like, whoa, crap, it failed, right? It was a double top. And so you had to choose. And look at that, came down. And if you didn't choose to just get out here, which sweep down may have been selling from this concept, it'll hit you. But I think the safest place is probably here. Putting your stop here seems silly to me. Like, it's almost like, well, if it's going to push a new low, it's probably going to close the gap, right? So I don't think pushing a new low would be the most sensible thing to do. But if we were to get this down to hit these stops, well, you're starting to put this position in advantageous spot. So I think, well, with all of this balancing out together, I mean, VultiWap is really looking like a pretty decent spot to get to because it's got an expansion bar there. it's going to take out plenty of stops. It'll probably get a bunch of people to be like, crap, I'm missing it. Clearly it was a double top, and this is headed straight down to zero, and it's going to be all the money's down. So I think Vol 2 Up's a good spot to put in your head here. If you're going to try it. Now we're going to get a response likely, and we're just doing price analysis here because there's really not anything else to do. So we've sort of shifted gears. I'm just enjoying digging into these price bars. Now we've got these stops here that likely got triggered right in here and filled. You can see that little range. And then we'll get this nice little pop up because there was probably people who bought here and here and here because people buy high because they do. And so there's a good chance we'll probably move back up to this range. And what's happening is this is that spread concept. You remember where you really were just trading to yourself. And these people were buying and they thought it's a good trade, but really they didn't have anyone on the other side. There was no narrative. There's no reason for institutions to support the position. So they just bought and sold to themselves, really. And so the market will tend to hit their stops, move back up to the average, wherever the average position was, and then we can continue forward. And that's a spread. You could tell it's a spread because that's what happens, like all the time. You get in, there was no reason for that to happen. It runs to the stop and then goes right back to the entry. And then the people who got in on the original one see the stop hit, it comes back to their entry and they say, oh my gosh, I was right. I just got stopped out. And they try and trade it again and it struggles. They get scared. They stop again. And it ends up they're depositing tons of money into this trade. And by the time they quit depositing, it rallies because they just deposited a whole bunch of money. That's the way it seems to work to me. I'm sure you've all had that experience. So in this context where we have the spread concept, you sort of take a look here and you could say, oh yeah, probably, I don't know, average about here. We got a little expansion bar there. Maybe that'd be a good spot. Get there. And if we could get this to just come down one more time, that'd be great. A low 2, we get the low 1. That looks like some sort of crazy nonsense. Low and then a sub 1 there. And you go like that, you get a low 2. And that's great. Something here, treat that like stops or whatever. So I think stops at best would be here, but it's kind of wide for retailers in a range that's this small. So I think if we got down to the expansion bar here, would be probably good, right? I mean, that makes sense, right? And we're just looking at this little price range and we're treating this price range like it's shielded from the world in its own little world of nonsense. Really, we're treating it like this market is stochastic. And stochastic means all historical data, everything that has ever happened is completely summed up and contained in the most recent data point, and nothing can be gained from the past to predict the future. That's really stochastic means that. You don't need historical data. Now, we know that markets are not perfectly random, nor are they perfectly stochastic, mostly because people, not computers. Computers can deal with stochastics. Randomness is, in my opinion, easier to predict with a computer than you. Like, randomness has limits and rules and things that it does. People just do stuff, and they can make dumb choices much longer than a computer can keep up with them. So people are a little harder to model. Randomness, I think, is easier to model. And so in this, I think the market's looking in these little price ranges. I'm treating it like it's stochastic, with people playing, trying to take advantage of a stochastic market using things like supports and resistances, which is sort of silly because if it's stochastic, none of that matters. But markets like to go where the volume is. So if you're trying to trade this like it's stochastic, like it's random, and then you're putting your stop below a pivot, it's like, well, the market's just going to go to where your stops are because it's stochastic, and that pivot has no power to stop the market because it's stochastic. So the only reason that a pivot could ever protect you is if there is a reason for an institution to inject capital into that pivot when it's being tested, not after. If there's no reason for an institution to put $1 million down on the table and buy up stocks and start altering the direction, the random walk, I guess you could say. It's not really random, but it sure sounds random when you call it that. If there's no reason for that, there's no reason for the support or resistance to protect you. There's just none. It's stochastic. Stochastic. Google it. So that's where we're at. I think that we've got some smaller players in here, but I think, again, we're running into the narrative, and the narrative is if you let this go down too far, tisk on you, bulls, you're giving up a good opportunity. And so far, we've seen pretty decent behavior out of the bulls for the last week. So there's no reason for me to think, well, they're just going to drop the ball now, because I haven't seen that. And so why would I think? I mean, I haven't seen any data points that suggest that at all. I haven't at all. So I don't have a reason to think the bulls are just going to drop it. If anything, I think we could see some difficulty in the market playing games, and there could be some teeth here, which is because the bulls are already in. There's no reason for them to defend any level. As long as the market doesn't come back down to their position, and even then, I don't think institutions really care that much. They do different calculations. So they're like, as long as we don't get liquidated, really, is the deal. But of course, they like to see positive numbers, just like the rest of us. A little green does a body good. So that's where we're at. We're just sort of playing games here. Let's take a look at the inversion. We have this is a ways to go. Looking at that, our highest tick right off the open was all the stocks ticked up. I mean, really the tick equals the advanced decline right at the first tick, because they're both calculating the same thing in that moment. And then right here, you can see, well, you kind of see, I'm not really sure how great you can see on the stream, but we got negative 533. We got to get all the way up to 1600 to get the tick up to a new high. That's quite a ways. That's a big chunk of the market. There's only like 3,060 stocks or so in the New York Stock Exchange. So half of them need to all uptick at the same time, and that would get us there. Okay, here we go. So here's our second move down, our nice low 2. And what I'm looking at here is to see, hey, is this going to function the way I think it should function in this context, which is really try not to go under this level. Here's an expansion bar, which is where price got very directional and didn't retest. So it's like retest, and there's this section where it never really came back. And we're looking at the beginning of it, right? So right in about there, that's what I'm looking when I say expansion bar. That's what I'm looking. So we get down to the VolTWAP, which is near that. And that's that low 2. There's our low 1. Here's our low 2. We get right down to that area. Is this a spot where there's going to be enough stops when we could thin out the herd for the bulls? We're going to mess around with the bears a little bit here. I just don't think it should keep going down. This will be the worst decision for the bulls, because it'll capitulate for the bears. They're going to be like, oh my gosh, we can get out, and they might flex. So I don't think that should happen. I think the bulls should just step in with some bullishness. They should say, All right, we're down to 13. 13. So can you see how, like, we had this particular speed going on here, kind of almost, see that? I'm trying to just like eyeball to kind of get an idea. And if you were to just do a straight line, you can see it's sort of picked up, right? And look at that. Look at price started to accelerate down, and it's like, who are you guys doing? Stop penning your orders across the stock market. That's what's happening, is they're penning these orders across the stock market. They're trying to get filled. Maybe they're just flickering orders. Maybe it's just fluff. I don't know, but it's making the stock sort of like lean. It's like, and the result is that it's having an impact on price in the ES, whether they're filling or not. And it's like, oh yeah, I know you guys want to get in there. I do. But if you keep doing this, if you keep filling your orders across all the stocks, you're going to shoot yourself in the foot. That's how I feel about it. So I think if they're intelligent human beings, they should have algorithms that go out, pick up on this stuff, and they go, well, slow down. This is too much. You're consuming too much liquidity. So that's where we're at. we're getting close to that position at about 3,000, right? Just a little above, maybe it's more like 3,100. We'll go with 3,000. It's just such a nice round number. And you could say, oh, we see how the price is moving down, and you could see in my opinion, the objective is to try and get some liquidity for the bulls. We got an hour left in the market. There's not a lot of time. I think the bulls are like, oh, we really like some here. And it's like, guys, like cutting it close in a lot of areas. And that's, I think, what's happening right here. The bulls are having a hard time being able to figure out how to wedge themselves in there to pick up some extra risk, expose themselves a little bit more before we potentially blow out any bears who happen to be here. That's our current situation. There's not much going on headed to where it's headed. I think the focus in this is mostly into the close. A lot of the times in the last hour, it's like, well, what can we do in tomorrow? But I think this whole thing is like, I think we want to get price as high as we can into the close, but can we pick up a whole bunch of crap in before that happens? We got 1 hour left. Yeah? You're dreaming about stores. What happened?
The app store.
You were dreaming about the app store? He's constantly asking me for new apps on the tablet or iPad, and he was dreaming about it. Okay, so you can see where we're at. I'm gonna go talk to him about the app store because this is more interesting to me than this right now. I'll be back in just a minute because I kind of want to hear his story while it's fresh. All right, I'm back. Okay, so you can see we got our low 2. It got down right to the VoLTE-WAP. Didn't quite get to the expansion bar, but we didn't zoom in super close. I didn't zoom in super close to exactly figure out where that was. But we got down there. You can see in moving down, I don't typically look at trapped orders during like little thing. I put the trapped orders up against anything that's creating signals or important events so that I can track the retail traders. And it's more, it helps as a timing tool, but it also helps indicate if there is volume supporting it. You can see that if we had ourselves a little low too, that right there at the low, the bar was green because there were sellers trapped. And it's green because you buy against sellers, you sell against buyers. So right there you can see there's some sellers there, and that's kind of the spot where we were looking for. So could you say we're getting what we wanted? We got the market leaning down. It's been careful so far not to let these bears out, the ones that we pinned down and figured that they had a position right there. Could we say that the bulls have essentially been pretty careful not to let them out, and they're taking their time? I think, yeah, this is sort of meeting, it's meeting that narrative. It really is. The only thing that I really don't like is that we don't have a ton of data points. We just have that one bearish position, and I still I really like a little bit more. This was okay. Having the market come down to about an expansion bar that you were looking at, hit the VoLTE, give you a low 2, bounce off of what apparently was just stopped sitting there. The big issue that I currently, it's just hitting me is I don't really like price action analysis. When you're doing the analysis of stop losses, and it's stop theory, this is stop theory. So when you're doing stop theory, it tends to be that you're in that place because the market is slow. And you get to the point where you can start picking out stop losses and the market starts bouncing around. It's clear. Well, markets just go stop to stop to stop when there's nothing happening. There's nobody injecting capital, causing price movement. This isn't price discovery. This is the market pandering to volume. That's what's happening. So when you get markets doing stuff like this, and the way you determine that it's doing it is not by looking at it. It's by being able to predict where stops are and then see price sit and bounce around those levels. And you say, oh, that's not super, I'm not super enthusiastic. But today, the stop theory sort of played into the fact that we were looking to see the bulls keep the market above these guys here. We're still, I think this is probably where the stops are for most of these folks here. Just because you don't have a whole lot of choices. So I think that this dip down here is probably one of the best spots if you're going to try and take advantage of it to make an attempt. You need to be concerned. Let me tell you why. Where are the bulls? Yesterday. They're right here. So if you're going to say, well, I'm going to buy here because it's bullish, remember that you're sharing a trade with these guys. You see the problem? It's man, I would really love it if there was a bullish position, maybe not 50 points away. That's just a long ways to reach. And so you're putting yourself in this tough situation where you're like, do you believe that those bulls will inject capital here? Do you think that this is a reasonable spot for the bulls to say, let's defend? Would you, if you had a position at way down there and you're up tons of money, 50 points, and you saw this context is right now, would you be like, all right, let's inject a bunch of capital? Right? Maybe. Yeah. That's a big distance between your position and where you're. I mean, well, what if you injected capital in the market and the bears decide to flex on you? I mean, they have a long ways to go before it actually gets to your root position. So using capital to sort of drive the market here, where there's no root position, where are the bulls? There's not even a bullish sample. Still, even though it's like, I need more data points, guys. Come on. Where is everyone? We're almost there. just 220 more. So advanced decline could stay above 2,000. Big thing, just make sure you don't let those bears go running. Just it's not going to be healthy for the bulls to maintain their control. So this is starting to look like an issue to me. It's like we're running out of time, 45 minutes left. We're real close to bulls getting liquidity. I'd love to see some bullish liquidity just right at these prices, just above 3,000, get a bullish sample. If we could get velocity to come down to just be like, oh yeah, that's good. 45 minutes. So in 15 minutes, we'll have another bar close on the 30-minute velocity. You can see it sort of stair steps down, and it's getting smaller, but maybe a little down. We're getting closer, and this is getting tougher. And the question that I think is just really relevant: would you inject capital now? If you would, it's because you don't want a bullish sample. You just want to take out the bears. Okay, so that's why you would do it. That would be bullishness, where that you say, I think it's reasonable to just start pushing instead of getting some liquidity presented, tying up contracts and capital in those contracts, and then see that work. Or now, if you don't push here, then what I think the bulls are sort of saying is, we really want that liquidity position. And then I'm like, but what about the teeth? Like, you guys already have a position. So there's no, like, it's harder for me to say I want to play with you because you'll have a lot of fluctuation room that I may not want to tolerate that sort of volatility. It's your second position. Like, this would be my first position. So it'd be really tough to chase here, or to follow, or shadow, or whatever you want to call that. So it's like you start to run into these logical problems that this situation presents you with. And I think it's important to keep in mind the context. And I think what we're seeing here is that we had two scenarios, right? It was like we could see the market move up, invert. But then, remember, we pulled up this chart here. We were looking at the inversion. Man, it was up way up. I would have loved to see an inversion. We got this way up there, and it's like, maybe that's not super great. In my opinion, if you can't get an inversion, you need equity, you need money. So if you can't trap in the other side consistently, right, all the way up, squeeze them out, which it looks like the market's having a hard time doing, then you need to inject money in the market, and it does that thing where you put money in and prices move up, and that would sort of look similar, where tick really wouldn't shoot up; it would just prices start to rise. So that's where we're sitting here looking at this. It's like, do the bulls want to pick up liquidity, or they want to try and invert? The inversion's had a hard time, but if you take too long trying to grab up this liquidity, you're going to run out of time to rally the market, and it puts everybody in a pickle. Can you see the complexity here? Like, this is becoming a complicated trade. Now, overall, the idea here is still bullish, but I need a little more data points. Like the conflict here is still pretty thin for today. For the last 3 days of data, it's not. I think overall it's a pretty clear story. But for right now, you're sitting here going, well, and you guys are putting yourself in a tight corner. This is a tight corner. Getting this liquidity, this little bit, this little smidge here, right? This is a tight corner. We got 12 now. We're up 12. So you can see the advanced decline right there, up at the top, straight up yellow, 229 or 2,290. That's pretty good, and we could get this down 12 times 20. So 240. Right, take that off of 2290. We're still well above 2,000. So it's like we could still get that velocity zero test that would give the bulls a chance to hop in and not see advanced decline get too beaten up. Still have those big, hefty, high numbers, sure. So that's good, but how long is this going to take? And I think 8 minutes, we're going to see this pop down a little bit more. if I had to guess, we don't get it. If I had to guess, I would say this seems to me like it's going to get just as close as possible to letting the bulls pick up liquidity and never really get there, and then zoom away, because this is not about the bulls. This is about taking out the bear. So I think we're just extracting every ounce of time delay and price delay we can. I would have to guess we never actually get there. We don't need to get there. There's no reason for the bulls to take up and use up that extra capital. I think this is that getting us nice and close will put a lot of people on edge, and then we can take this up. We could take this up right through here. And it could be at this point, in my opinion, in the last half hour, so it could be quite aggressive. There's no reason that you can't just aggress this up. The bears have sufficiently been in. I think they're just demoralized out of their minds. They've been sitting on this for hours all over the weekend. I mean, think about what your weekend would be like if you try to short it and hold on to the lows. And then it opened on Friday, and then all Memorial Day. You just emotionally, you just want to die. So that would just be the worst. And we open higher today. They are so demoralized. And then they try to do something about it. So still, I think that hopefully you can understand that we're in between this and we're running the clock. I don't think it's necessary to pick up the bulls. Getting nice and close is going to be a good crowd thinner, right? But this has been about killing off the bears the whole time. So I still just I'm still not seeing any case for the bears. Still bullish to me. I want more data points. We're running out of time. That's probably it. I'm gonna guess that this is probably over the past next half hour or so gonna mostly move up into the close. And I yeah. Mm-hmm. Yeah. Okay, and I'll tell you why. We put together a whole narrative. I think I had it pretty well pieced together about here. Started streaming here somewhere. I don't know. We worked out the narrative around it here. So putting this narrative together, we're getting one nice stream of narrative. We got right to our expansion point, right at the Voltiwap. We've kept these guys underwater. We're getting everything we wanted. And that's what more can you ask? Like, we can't get it to move down much. If we move down too much more, the bears are going to become emboldened again. I'll say our position is positive, but like, I really think that this is a good spot. I do. But at the same time, I hate that we don't have more data points. It drives me nuts. I want a couple of points. I don't like days where there's just nothing to look at. It's like there's nobody in a room. How do you decide what's going on in the room if there's an empty room? Man, this is... So I'm going to flip over here, take a look at our dollar, which has moved down, slowed down a little bit. Well, it's in the move down position. Debt sideways. Volatility hanging out. Trying to find its new normal still. Gold slid down a little bit. Coming out of gold, coming out of dollar. I still don't see a case for the bears. I don't. I haven't all afternoon. The thing is that I'm looking. I want to know both sides. I don't want the bears to be able to create a case for themselves and then show up to the table suddenly and say, "Boom, here's my case," and you're like, "Oh my gosh, that was actually a pretty good case. Like, what was I doing?" I'm okay with all of it except for one stinking thing. Where's the liquidity? Where's the stinking liquidity? I love to see liquidity. We just have that one spot. I mean, the moving up from here would just essentially be the bears surrendering, maybe the bulls injecting some capital, but so positive. Why would you do that? Why would you inject capital 50 points positive? It's like, let the market do the work. Let it fall 10 points. Kill everyone. Ruin everyone's day. Maybe that's what we want to do. We ruin everybody's day. We shoot the market down. Let the bears get emboldened and then inject capital into the market. Bring the market down, embolden the bears, and then wipe them out. Is that reasonable? No. I don't think so. Ruin everyone. You gotta take out both sides. Problem is you'd be letting the bears out. Can't do that. I don't think it makes sense. Sometimes that'd be a good case. And I think if it was a liquidity position, that might make a little more sense because they tend to have a little bit longer scope on them. But with a risk reduction at the low, these are like shorter term blips. You get into the market to try and get a little bit of an edge. And in this case, I think we have them trapped, and moving it down with that short-term scope on it won't function the same way. So I think moving down would just alleviate the pressure to move up that cash there. I don't think it would be good. So if it does, I think that a new low now would embolden the gappers, but the gappers don't have time. They probably have already left. Tension get too high? Do we get too high on the tension? Is that what happened here? We're about to run into that velocity test. So keep our eyes on price. One of the things I like to look at, especially in an intense spot like this, where things are just, tensions are high for everybody. Well, for the bears. Tension's high for the bears. Take a look at how price reacts as we get closer to this pivotal moment where velocity's looking at zero. And you get a sense of how the market's responding. Because what will happen is you get these eager players who try and front run the situation. You can see them doing things, and the more enthusiasm there is, you can sort of pick up on that. This is something you should key into and say that has super big meaning. But looking at this context, try to model the downside, but I still don't think it's good at all, because it just wipes out the whole. It's not that it ruins everyone's day; it just ruins the structure of today's potential. The fact that there's a good chunk, I really think we could get to 30-20. 30-25 wouldn't even be too. 30-20, sure, or just about there. Off of this structure. I think this structure is good enough to carry us up there, and that's a good 15 points away from where we are now. And if it moves down, well, maybe 15 points just isn't enough anymore. People just want more. Used to be 15 points was amazing. Now it's like a little, like it's flat. Anyway, so I think that we still have enough to get to like 30.20. I think that's a good spot. Overnight highs. We got everything in. Moving down and letting those bears unravel their position would limit that capacity to get up. We might be able to get some bulls in there and maybe eject some capital, but it's almost like you trap them in and then you don't take them out. Why would you do that? Well, we're almost there. We're almost to our data point. Getting that to 0. Hmm. It may be that we've got a half hour left, and we're running out of really room to do much today. And so we haven't had a whole lot go on other than that one data point that I think was really gave us a whole lot of information about what's happening. The focus is shifting. Remember, negative 65. That was about, remember, it was about 65 is what I was thinking, maybe about there, mid close. Negative 6, that's quite a bit of downside force on the market. It doesn't mean it's going to topple the market down. What it means is it allows some motivations to shift around, such as the bulls. If they get sampled here, it's like, well, what's the mechanism that they would use to drive this up in the face of such counterforce? We have the bears in there, right? In there, we can use them as a mechanism to move prices up higher. That would work. Our tension hasn't, the tick hasn't set up a really good squeeze or inversion. It's going to let us trap. So I think this might be focused on tomorrow's activities. A dip here is not going to be good for the bears over the course of tomorrow. The bears liquidate. Let's say it comes down into the close and they get out. Imagine they probably need to get down probably around here. First stop would be the lows. Then we're already like headed down. Well, hopefully you know what this enthusiasm was about. So the bulls just didn't quite do enough, and you can see that these bears got emboldened. They were like, oh yeah. So they're flexing. That's what that was. It was a big old flex. And I think this is ridiculous because I think the Bulls had an amazing case. And I think the mentality here is pretty straightforward. Do nothing. It's too far positive. Don't do anything until you get an advantage in the market. And I think that's what's going on. So we're having this push down. It's going to embolden these bears, which we just saw. That's what that sweep was. We've been talking about as you get too close down there, they flexed. And it's not that and that was the thing, it's not that they couldn't. And so you have to be careful about that. And they just weren't careful enough. They got a little, this is the teeth. And now it's moving down. So we're almost at the 4. And there's a lot of people sitting here going, okay, we got the bears are in, everything's good for the bears, and the velocity is about to go negative. That's the confirmation point to sell everything. This is going to be hard to sustain. And I'll tell you why. The bulls haven't failed yet. Where today have we seen a bullish liquidity sample, which is velocity or decay, hit 0, and then the bulls did nothing? We haven't seen that. What this is as far as I can tell, the bulls allowing some destruction. I mean, they're ruining everybody's day. And so velocity, now it's at 5, just a little bit more. We could get that over 0. Again, I still think that this whole thing is supposed to be about destroying the bears. We see that in trends all the time. It's a common thing. It's not that I'm saying that I think it, like this is something we see regularly a couple times a month, or not a couple times a week, that you set up a trend by allowing the counterparty to think they have great opportunities, everything's going well, and then taking them out as soon as they slip up even a little. And I think that the bears just flexed. And I'm almost wondering, sitting here going, well, that wasn't quite as successful as maybe the bears might have wanted. If you're trying to liquidate your position, remember like 2099 here, because they're cash averaging into a loser, right? Boom, boom, pop. It just, I think this is just a bullish opportunity to buy into the market. And I still think that if you just don't get a liquidity sample, that would really drive a lot of people. I think the best thing to do, probably the safest route that I'm going to be looking at here is getting that velocity sample. I know, but I don't like operating around a lack of data points. I've been saying this for a little bit. It's just, I love data points. I love to see the velocity come in and get samples. We see bulls, we see bears. Right now, it's like these assumptions we're making about what they're doing. And it's not that we haven't been getting the stuff we wanted. I think we've seen behaviors that show us that our narrative's not wrong. But we don't have the data points to really say we have bulls injecting equity. And that's the frustrating. So this is creating some complexity. It's gonna be really hard to deal with. But the clouds are gonna part. At some point it's gonna be like, and I was a little bit like, I think this is okay of a spot. And the reason I was hesitant was because bears, we're just so close to the bears, we don't have data points. So I think the market's looking for data points. Once we get those, I think everything will start to line up. I think I'm going to feel a lot more confident to try and maybe do things over here on my end once I get data points that say, here they are. And so far we've just had, here's a narrative that's really pretty good, but no data points that really suggest that bulls were buying or bears are selling. We were looking at stop theory also. It's like, that's not my favorite thing to be doing. It suggests really like a low level of activity. So we're gonna stay and sit. I'm waiting. I haven't done anything. I thought that dip down to the expansion was pretty good. Just a second. Okay. So here's where we're at. Sorry about that. So velocity 4, still the next event to really keep your eyes on. We've been watching this since it opened, which is velocity getting to 0. Decay won't get there. Take a look at tension. So one of the things that will happen if these bears do get out, if this crazy decision to let the market come down because bulls have such a good position, if it does get to, we're going to keep our eyes on tension. Right here, right there. So if they liquidate or they exit or something, that's where we're going to see it. So if these bears into the close start to just empty out their positions at break even, we'll see that curl. If they don't, tension's just going to keep going up. I know it's getting close to the close, but that's what you're going to say, are the actions happening on the inside that I'm looking for? I'm waiting for that velocity sample. I know I'm like, don't get there, don't get there. I know. I'm still waiting for the clouds to part. I think the bulls had a pretty good case going through this whole afternoon, and it has done nothing but churn everybody. Now we're waiting for this velocity sample to show up. Once we get that, we're going to have a solid data point, finally. We get that data point even into the close. I think it would be very useful and hopefully telling. This is the bears flexing. Remember, the bears were in that position. They wanted a dollar cost average to save their butts. They got in there. It was not looking good. It leaned down, and I think things started to play a little bit into the bullish mindset or bullishness. Then they decided to flex. We had a good flex right there. That's what that was. I have no idea what it is that they printed into the news articles. It really doesn't matter. What happened was that they were like, oh my gosh, this is our chance. If we don't act now, bullishness is going to pick this market up and up through the highs. I think that was what would have happened if they had not hit that algo button. So why were they willing to do that? I think it's because the bulls have such a distant position. They're too comfortable. They're not willing to inject equity into this. It wasn't able to push up. We didn't get bigger fish coming in. I mean, we had some complexity. It was looking really juicy. And it's just leaned away from it. And now we're in this spot where we're looking at letting the bears actually get out of their position. And it's just like, bulls, you guys, like, you think you're doing a good thing, but you're giving the bears an opportunity to take a crap position and potentially turn it into something that can work for them. And that's a problem. It's just bad trading. So all they needed was a good algo or two. I think it could have pushed up. We could have just wiped out the bears and the bulls would have been happy. So you need to ask yourself at this point, why? Why? So if we had had more data points for the day, I would be making some heavy conclusions right now. But because it's leaning down and it's unfavorable to the bulls because the bears, we're almost to the sample. See, almost there. We're at 2. So we're just waiting here. So if you're sitting here watching and you're going, oh my gosh, what happened? I have no idea. But I can tell you right now that the timing of that bearish flex was perfect. We got right to the expansion bar. The bulls were, I was like, I think this is actually pretty good. I had a bullish mindset. This is pretty good because at that moment, this was going to start drift up. The bears realized it. They flexed their muscles, whatever it is that they do, came out. And I think that was a discretionary moment. I do not, any part of me think that that was spontaneous. That was a discretionary move by an institution to try and salvage their bearish position. This is a salvage operation. That's what it is. So we have this movie that we're about to get that bullish position. So I think that what's going to happen is there's about to be one heck of a scramble. The bears are about to say we need to buy a whole bunch of contracts. In fact, 3 days worth of longs to cover ourselves. And the bulls are about to get a velocity retest. And they're going to say, hey, we might want to pick up some of this liquidity. That's both players trying to execute the same type of order. And so I think we're about to see some demand spike the market up. Keep your eye on the velocity test of 0. Watch the trapped orders. You can see right here. So this definitely inspired a lot of retail traders to click the sell button because of the aggressiveness of the move. I think that this is creating the type of conflict that I think is a little bit more actionable than what we had before. It's just really skeptical before because of the lack of data points. But now we're going to get a velocity sample. We're going to watch those bears try and dump their position, which means buying. We're going to watch the bulls potentially pen some long orders, try to get filled, and we could get a good old-fashioned scramble right back up. And I think that's what we're looking at coming up. You need to watch this. This. We got to see those trap orders finish up. So if you're a bull and you're trying to pick this up, what you're waiting for is you're waiting for all the retail orders who are flickering to stop or slow down. And you grab up those orders and you fill against them. That's it. So I don't think that that's exactly how it works, but for this model, the way that I like to think of it is that the orders are percolating all over. There's everywhere. And then as soon as they slow down and it gets down to 0 or at least very near 0, they're slowed down. They pick up all those orders and they say, do you want to fill against these sell orders? And it's like, that's not fair. And it's like, well, did you really think that it was fair? What would be the point of fair? This is a business, not a charity. So here's where we're at. bears flexed. We're 1%. So we're 1%. Oh, we're just getting to zero here. What we need to see is we need to see the signal first. You see the signal, and you'll see it show up. It'll mark it. And this captures intrabar movements too. So if it dips down and then moves back above, it'll still mark it. We have the intrabar movements captured. We need to see the signal, then the volume. Okay, you don't see volume first. What we're trying to model here is that the market has the ability to show jazz fingers, look, and all the retailers go, data point, and they execute orders. So you need to see the signal first and then the volume. And in this instance, with this trap, we're getting to zero at the same time this is finishing, and that's the wrong order. So don't act here. You need to wait till we get the actual signal. You need to be able to say, oh, there it is. Okay, so all these traders saw the signal and then they acted. So now we have that signal. Now we need to see the action. So we need more sell orders right here. I absolutely believe at this point we have a lot of gap traders who are saying go, 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 go. Lots of people who think this is going to close a 50-point gap and that we need to just sell, mortgage the farm to capture this gap. I think this context that's still a little silly here. Maybe, but okay, look at this. So we got tension starting to curl down here. We got down 2988-ish. So we're starting to see right through here. Those stinking bears are getting out. Hopefully you can sense that this was a big missed opportunity by the bulls. They just did nothing because they're such winners. Oh, we're such winners. Okay, so we had just a blip there. Do you see there's a blip of sell orders already gone? Some sell orders. Come on, there's some sell orders in here. Just waiting for those sell. We got 10 minutes. We're about to get our 50 order that the 10 minutes to the close of the exchange. I've been informed that there's often a little something that happens there, a little something special. So we got our sample still waiting on the trap orders. And we had just like a little blip there. Just like it was just, I mean, hopefully you saw it. Like it was just a little blip. I'd like a little more, but I think that's all we're going to get. And this is it. I think this is the moment to pick up a contract right now. And what you're going to be buying into is this whole narrative capitulating into a bunch of nonsense and laziness by the bulls and eagerness by the bears. And it's going to shoot back up as both parties try to pick up. But this is so frustrating. But I think this is the spot. I like this much better in terms of conflict, but the close 10 minutes. If you're going to let it come down and you're going to ruin everyone's day, you might as well keep it down into the close so that all the retailers are forced out of the trade that's going to win and they get to enjoy getting pushed out at a loss. So I'm not doing anything yet. I'm waiting. I mean, if they're going to do shenanigans, I'm not doing. I think it was this. We're getting there. We're getting so close. This is such a irritating day, to be honest with you. So okay, we're coming down. We're getting close. I want to see. Oh. Collared the market. I see some more trapped orders. It was just for like a moment there, and I don't think this is one of those moments where it's like just a little moment there. Like, come on, we need some trapped orders. We need those orders coming in because they see the negative velocity, and I want to see actual green bars. So just like a blip. It was like almost, and then nothing. And this is it's all of this analysis coming to this one moment. Just a little more volume. Just a little more. Just a little. Nothing. Telling me there's no sell orders coming in there. Monsters. So the way I'm taking this is, that volume was coming in. I want you to keep your eye on that, but it didn't line up, I don't think, with that. I think that was something else. So the market's going down first, down to 85. And so the way I'm looking at this is, why are you having such a hard time finding people who want to sell this at that signal? And so you sort of have this, like, the sales pitch problem, where in order to get people to fill orders on the backside, or essentially to be wrong so institutions can be right, you have to make a sales pitch to them. And they're making a sales pitch here, the velocity going negative after the whole day. And nobody wants it. In fact, I'm seeing people buying. Maybe we see buy orders coming in here. And it's like, huh? What? That's just not what I would. This is not looking like it's like the bulls just think you can get away with whoever you want, huh? Maybe they can't, but I don't like the structure, even a little. I don't like what happened. I think they just got too close, and the bears flexed, and that's the trouble. None. Nobody wants it. See that? No trapped order. No trap. None. You can see through here we had our range, and then we started back into impulse move. So we get this, you get like impulse, a little range, and then it impulses in a direction, then a range, impulse, and then a range. Stuff like that, back and forth. You can see we're in impulse mode right now. $2 billion to buy on the close, says Andy. Bring it on. Still no trend. Really? Buyers, people keep buying. That's not. I just need to get a bar, just a little, like a bar or two, 5 minutes into the close, and they're telling me nobody, like, retailers just don't want to sell this. They're just not interested. You know what? Did the Bears just pull off today what they pulled off last Thursday? Did they just cheat again? Into the close. Retailers are being held out. If this is going to effectively end up where I think it's going to end up, which I think is sampling these bulls, we're not getting volumes. So this liquidity sample hasn't been complete. We haven't seen people react to the negative velocity. There is no liquidity yet. We saw people react to that. The bears going, ugh, getting the market down out the lows to try and salvage this position they have. So we saw some reaction to that. You could potentially treat that as liquidity. I don't think it's the right kind of thing to think when you see that. Right now we have a very normal sample going on. We're not seeing that. So we're having this, what I call unorganized liquidity. And I say that is because we don't have the liquidity and the signal lining up with each other. And I think that happens because the market is flashing the signal and they're like, hey, everyone, hey. And everyone's like, I don't want to. And that's trouble. That means they're having a hard time with the sales pitch. And I see today a moment where the bears got in, and a couple hours later, we're able to either create or predict demand. It looks again like bears cheated. We did that last week on Thursday. And then Friday, they tried to keep it going, but cheating doesn't work. So whoever it is trying to short the US equity market, it keeps trying to cheat. And this is just the new normal. So who is it? Maybe somebody knows who it is that seems to have inside information about US equity markets and keeps trying to dump the market down like they did Thursday, but it didn't work. And I'm wondering if I'm sitting here thinking, well, if Thursday didn't work, what's the deal? We're probably gonna have a similar situation as we do on Friday tomorrow, except we got more tension. I still think this is a retail holdout. I think it made more sense if everybody wants the bears want to dump their position because they got stuck in, and the bulls want into that liquidity. We're not getting trapped orders. This won't rally till after the close. Keep them out. That's what's happening. This is very frustrating. I think there were some good opportunities in here from a narrative perspective. Hopefully you guys were using your tools and the narrative was able to help model what was going on in the market types and what was happening. And you're able to see what happened today. Frustrating. I would love to see this work out and have some good signals, but currently the bears just cash averaged into a loser. The bulls, where were they? Best chance the bulls have is to buy in after the close, after all the retailers have to close their positions and the stocks have to shut down. Then we'll see the market pop up probably overnight. So, and I think that because I think the bears are going to want to cover some of their bad trade, and then the bulls are going to want to pick up the liquidity, but we never saw trapped orders. So I don't know what that's all about. I don't know why they had such a hard time convincing retailers to sell that, or they were consumed so fast and so quickly they didn't even get a chance to hit the market. But we could see that the bears did have some impact on the market here as they flexed, bringing things down. Tomorrow, the conflict that I think is going to end up providing us some good opportunity is looking at the elasticity. I'm going to prep you for tomorrow, and we'll be back tomorrow, and we're going to figure out exactly how this is working. And I think it's going to happen probably early morning. So overnight, I expect a move up to the highs. Today's intraday highs. I think that this was just holding retailers out, and then after the close, we're going to see this move up. Tomorrow, we have the market is probably going to gap up. It's just a guess. Just because the market moves up overnight doesn't mean it's going to gap up overnight. If we can see this maybe open higher, but it'll probably open maybe a little lower, even if it gaps up. And the deal here will be, do we get tension sideways or do we get tension to release? It's going to depend heavily, probably on the first hour. So you'll need to be sharp. If the bulls screw it up in the morning, the bears are going to do what they did to just that a couple minutes ago again tomorrow. They're going to go, oh, great, you guys are out of the way. Let's flex again. Let's start shoving tension right down to zero. Their objective will be tension to zero. I think this is a pretty clear-cut case what is going to happen tomorrow. If the bulls show up and hit, they're going to hit, and I think the bears will just get destroyed tomorrow, and we'll see the bearish position that I think tried to just dump just a minute ago right into the close. They're just holding retailers out so they could shoot it up overnight. This was just a way to make the market exclusive so things move more quickly. Then tomorrow we're going to be looking at how can we get tension? Probabilities, are they going to lean because bulls fail? So watch for probably a velocity test, but it could be decay, either one. Or are we going to get tension go sideways? If the bulls come in and pick this up, probably won't pump a whole lot, but it'll be very dependent on trapping in bears throughout the day and absolutely an inversion. I just don't see another way to rise the market tomorrow with these numbers. We're going to need to invert the market probably pretty early. So that's where we're at. It's going to be a quick gameplay right off the open. You'll probably get maybe one chance to hop in, and then we'll take advantage of it. Overnight, I think this has a very good chance of moving up. That dive was just ruining everyone's day. All right, if you guys have questions about this, or any of these tools, shoot me a message or ask questions during the day. I'm probably better. I got the YouTube chat thing up and the Discord chat, so I can see what you guys are saying. If you guys have questions, do that or shoot me a message or something. I'll respond as fast as I can. I hope this was useful, and I'll be back tomorrow. Good luck, guys.